traders. Thanks so much, team. I appreciate the support. Now, please enjoy this episode. Here is my guest, Siam Kid.
So I'm sat in the Tesla right now, and Chat with Traders is in Spotify, and like you get so Spotify is like woven within the Tesla sort of main screen, and I saw Chat with Traders come up because I've liked it on my Spotify account, and I was like, wow, you're on like, yeah.
That's so cool.
You're in my car.
Yeah, it's very cool that some cars are coming out with apps built into them now. Like I know there's a few cars here in Australia that have like a Stitcher app and obviously Spotify and podcast iTunes and that sort of thing.
It's cool.
So yeah, I think this medium's only going to get bigger, which is pretty exciting.
Definitely. Are there many Teslas in Australia at the moment, or?
I've seen like one in Brisbane. I've seen like one, and I don't know how they got it. I think I might be wrong on this. There may be a Tesla dealership down in Melbourne. But yeah, I think that they are on their way to Australia. I know there was something a little while ago where a whole bunch of people were sort of putting down a deposit on them, but they haven't like shipped, like pre-ordering. But yeah, they haven't really arrived yet, but will be interesting to see when they do.
Yeah, they're going to take over the world over the next 5 years. I really think.
Why did you decide to get a Tesla?
I love tech. It was actually sort of a half-hearted thing. I love Elon Musk. I really do. I genuinely I really want to do like a green energy type project as an equal partner with him at some point over the next sort of 10 years or so. But like the speed, honestly, I just test drive one if you ever get the chance, as in the top line. And like I've driven all sorts of racing cars and Ferraris and whatnot, but I've never in my life experienced acceleration like this. It's relentless. So this one is 0 to 60 in 2.8 seconds, and it's just nuts. I just can't. Yeah, the novelty hasn't worn off yet. So
that is very quick. Especially when you compare that to that's the speeds of like Ferraris and Lamborghinis, isn't it?
Yeah, it's nuts, and it looks really modest. Like it looks like it's a family car at the end of the day. So
yeah. Do you like the idea of the car being electric though? I don't know how I feel about that, and it's strange because I'm not like a hard out petrol head or anything like that, but it seems kind of a little bit bizarre.
Yeah, it is weird. I mean, I love the sound of like a nice V8 or whatever, but it is freaky. I mean, it's really convenient because there's Tesla chargers all over the UK, so that's free, and it takes half an hour to charge up. And I charge up at home, so like every time I leave home, I've got 250 miles of juice. So it is convenient.
It's interesting to hear. I've never actually spoken with someone who owns one before, so very cool to hear. Okay, so I know you're sitting in your car there all propped up. Are you on any time constraints?
No time constraint. No.
Okay, cool. Well, I hope you're comfortable because there's a lot I want to ask you about. So when we were speaking the other day, you told me that when you were 25, I think you are around about 30 years old now.
Yeah. You
said when you were 25, you were stone broke. So let's just start right there. Like, what was your situation?
Okay. So sort of rewind a tiny bit. So I think like the year before, we like in the Air Force, the station commander got all of the pilots in a room, and like once a year they always had this sort of big pep talk. And he was talking, and he basically said, if you guys work hard, one day you'll be in my boots and you'll be, talking to your pilots, etc. And I sort of like wondered, what is a station commander actually earning? And I quickly asked around, and like within, people sat next to me, and they're only earning about sort of 80 to 90,000 pounds per year. And I was like, wow, I have to work another 20 years to earn just that. And I wanted more like something like 50 grand a month, etc. And it was that point I reread Rich Dad, Poor Dad again properly, and realized, I've got to do something. I've got to get out. And that was literally around the same time as my trading started to get more consistent. I mean, by then I'd done 7 years of trading. And it was, like every new self-taught trader. I mean, the first 4 years, I was every horror story you've ever heard, that was me. And I thought I was getting a bit confident because I'd have, these streaks where like 3 or 4 months in a row, I'd be like on fire. And obviously, my trading psychology wasn't fully formed because I would feel like I was, Gordon Gekko. And so, yeah. And like that, I call it Billy Big Ball syndrome. And yeah, it really flattered me because I left the Air Force. I was like, right, I'm going to leave the Air Force. I'm going to trade full time. And so fast forward to being stone broke, I left the Air Force with no safety net whatsoever. I only had 10 grand to my name, which all went into my trading account. And what I then made the worst trading mistake I think I've ever done. Basically, I didn't have a job. I just left the Air Force and I was like, right, I'm just going to trade full time. And I was going to pay my rent, my utilities, live my whole life, through my trading returns because I was, coming off the back end of one of these Billy Big Ball moments. And I mean, for the next sort of 2, maybe 3 months, everything was great. I was turning that 10 grand account into sort of 2.5, 3 grand a month. And I'm cringing now just retelling the story because it's just dreadful risk management. I was making 30% per month. And then lo and behold, either month 3 or month 4, I think I lost like 50%, and it was just ridiculous. And it was to the point where, I say I was flat broke. You're never going to starve to death in the UK, but I was setting up payment plans with energy providers because I couldn't pay the bills. We're shopping in like Lidl, which is like in the UK, that's our sort of cheapest store. And like the people around me know the cheese and mayo story. Or basically Ellie, my fiance at the time, came up with cheese in one hand and mayonnaise in the other and sort of shrugged. And basically we were struggling to decide whether to buy cheese or mayo because we couldn't afford both of them. And yeah, so we just had to buy more pasta and rice because that's dirt cheap and it grows. So yeah, that was sort of rock bottom. Yeah.
Full on. So what led to you getting into trading in the first place? Like we're sort of talking around the time when you're about 25 years old at this point, but obviously you started trading a lot earlier or like at a younger age. When did you start trading and what like led you into it?
So I was 18 and again, I feel quite embarrassed telling this story because I just joined the Air Force and I was going through officers training and at the same time I've always liked stuff, so I like cars and gadgets and stuff, and the Air Force wage really is quite poor. And I was thinking, right, how can I make money in my underwear in bed on my laptop? And 2 options came up, and one was online gambling and the other one was trading. And I thought, well, trading is going to take too much time because that's, the pros are screwing up. What am I going to do? And so I got into online gambling and, being the idiot that I was, I looked at online roulette and I thought, right, I've got it. I've hacked the system. And I now know, I think it's called the martingale system. Basically, I was doubling up every time I lost.
It's a recipe for disaster.
Yeah, exactly. I thought, what are the odds of me losing, 10, 15, 20 times in a row? And I quickly made about 3 grand's profit in like an evening. And I remember so this was in the mess, and I went to like at dinner with all my other sort of Air Force mates. I was like, guys, I've got it. I just made 3 grand doing online roulette. And I've hacked it, and basically they're all asking how. And I was like, well, I start with 50p, and every time I lose, I double up. And by then, I think the most losses in a row was like 7 or 8. And I mean, yeah, I'm cringing now because like the numbers and the stats behind it is just silly. And what I didn't know was that there was a maximum cap to how many times you could do that. So all my friends went into my room after dinner. And there was about 8 people watching me, and I turned that 3 grand into 4.5 grand. And then I think like 15 reds came up in a row, and I lost everything.
In front of everyone?
in front of everyone. I was literally squeezing the mouse, and everyone sort of left very quietly as I was silently raging. And I made my first big financial error. So I was 18 and everyone left, and I did the typical trying to revenge gambling. And I was like, right, I'm going to get it all back. And I maxed out a Virgin credit card. So about 3 hours later, I lost 4.5 grand by maxing out my credit card.
Oh no.
And yeah, so I haven't gambled since. Literally, that night was like my big dose of reality, and I haven't done since. And then, so I then moved on to trading, where I did considerably worse for the first 4 years. So
that's funny. So how did you go? Maybe walk us through your first year of trading. What was that like?
A disaster. I'm sounding like I'm a bit of an idiot. Well, I was, but I'm not now. But it was Alta Vista back then. I don't think Google was around, and I did a bit of Alta Vistaing. And after about a few hours of Google or research, I thought, right, I got this. And so I opened up some sort of I didn't bother with the dummy account because I didn't even know that they existed. So I opened up a 2 grand account, and I lost it within that first day. And that was my first experience of a margin call, and that wasn't very nice. And the thing is, with the Air Force, I managed to live off just 10% of my income. So literally 10% of the income paid for everything, because the Air Force sort of looks after you and they feed you and clothe you and whatnot. And the remaining 90%, I was literally just blowing on the markets. And every single month for the first year, I was blowing 2 grand a month on the markets. And so I think I lost about 50k in my first year. And I think through stubbornness, I just carried on doing that for the next 4 years. And I think all my mates thought I had a bit of a gambling problem, which I think in hindsight, I think I pretty much did. I was just obsessed with the 1 minute chart.
Yeah, that does sound like a bit of an issue, especially if you're losing 50 grand a year pretty consistently.
Exactly. It's pretty much all of my wages every year. And I mean, have you found that yourself? Like, from seeing like new traders, people do always slip down into the lower time frames, and I feel for beginners that's really quite dangerous.
Yeah, we'll definitely get into that a bit more. I'm interested to hear, what did your fiance or your girlfriend at the time, I forget which it was, but what did she make of this? Obviously you weren't in a great financial situation, and most of your wage was supporting your trading habit.
Yeah, so I think she was hoping that this trading thing would be a bit of a fad. And she, obviously she said, why are you leaving the Air Force? Because it was everything I, dreamt up, aspired to achieve. And but she was supportive when I did leave. And yeah, it's hard. She didn't approve, especially when I'd lost, turned a 10 grand account into 5, and then later on a 3 grand account. So that wasn't too good. But I don't know. I suppose she just trusted me that I'd sort of dig myself out of my own sort of shithole, so to speak.
You'd work it out.
Yeah, and in the end, I just had to. It was quite sobering, because I had to just go and get any old job, and it was a massive reality check for me, because I went from having a really nice paid job to having a 16 grand a year admin role at some recruitment company, and it was just it was quite demoralizing, basically. And because of the lower income, I couldn't my trading pretty much stopped.
So why did you decide to go into this admin role instead of going back into the Air Force? Did you just want a job that was just giving you enough money to get by that you didn't really have to care about too much? What was the idea?
Well, one, I couldn't rejoin the Air Force like that. Once you quit, the door is closed. And I literally, because I screwed everything up, I just needed some income because I couldn't pay any bills. So I literally went to, not the job center, but I think it was one of the online job boards, and I just applied, the standard, applied for 20 odd jobs, had 10 interviews, and all of them turned me down apart from this admin job. But yeah, so I mean, I was still trading. However, I was trading like a $2,000 account, which is literally peanuts.
Very difficult.
And I was just, I had to go back to the drawing boards, basically.
Okay. So how long did it take you to become profitable?
I think it was really soon after that. I think after really screwing up, I went back to the drawing boards. And I think only 6 months after that huge screw up, I just started being sensible. I was being extremely picky. I finally got my head, like, overnight. Like, there was one morning I woke up and, like, risk management finally clicked in my head, so to speak. So I think from year 7 onwards, I traded way less. I was going back to the daily charts only. I was placing probably one trade a fortnight, and I was just being really selective and making sure that the triple R was there. And I mean, I'd always paid lip service to triple R, but I made sure my triple R was 1 to 3 minimum, and preferably at least 1 to 8. So yeah, I mean, I was on a massive self-development sort of drive. I mean, I was reading, like, I was going through about 3 or 4 books a month through audio books and stuff. And I'd read, Market Wizards and like all of the standard books, so to speak. And Van Tharp was a huge help.
So, with the power of hindsight, looking back, you said it took you about 6 to 7 years to become profitable consistently.
Yeah.
How would you have shortened that amount of time?
I would, if I had someone who knew what they're doing, that would have been rather handy, someone to actually ask questions to. But all I was doing was just Googling and trying to basically trial and error and developing my own sort of BS detector, basically. And I fell into every pitfall you could ever make, from strategy hopping to buying black box type things to day trading to, well, scalping. And scalping is alluring because sometimes you can make, a hell of a lot very quickly, and then the next day, obviously the underlying thing here is that I had very poor risk management. I mean, there's no good or bad forms of trading as long as you have good risk management. However, my caveat to that is that if you're a new trader and you're like in your first year or two, I would highly recommend staying away from day trading.
I know you feel very strongly about this. Let's just get into it right now. Why do you say that? Why do you try to encourage new traders away from day trading?
Well, I've got this sort of mantra that boring trading is good trading. And my trading has always been really good when I'm bored out of my mind. And the thing is, with day trading, maybe it's because I've just been burned massively through just sheer stupidness. But when you're looking at the 1 hour charts and below, or let's say the 5-minute charts, because that's quite popular. You're sat there staring at your screens, and every 5 minutes you have that new candlestick, and you're constantly second guessing yourself. You're looking at the markets. You're staring at the P&L, and it sort of forces you to sort of make decisions, quicker than you really need to. And what a lot of people do, because like if you're looking, like everyone has done Investopedia or whatever, or gone on to Baby Pips and taught themselves the basics of trading, and everyone's aware of support and resistance and stuff like that. And the thing is, when you're looking at support and resistance on a 5-minute chart, like the ranges or all these levels, they're all very small. So you may look at something and go, oh cool, yeah, I'm gonna go long here and have like a put my stop loss below this level of support. And your stop may be, 10, 20, 50 pips. But when you look at the bigger picture, you'll see that where your stop loss is right in the middle of all of the chop. So I suppose the learning point there is that even if you are trading the lower time frames, you need a multi-time frame analysis. You need to always look at the big picture. I mean, don't get me wrong, I do day trade when I want a new toy or whatnot. But again, I'm even when I'm doing that, I'm still not placing that many trades, and I'm super, super selective. So only taking trades, going with the trend, and etc. And also, like, you have to understand that a lot of I don't know what the stats are globally, but I know in the UK there's only 0.1% of the nation that actually trade. So at any point in time, there's about 100,000 traders in the UK trading, and I would hazard to guess at least 95% of them are losing hand over fist, because most of these traders are, retail traders that have done a course, or they're teaching themselves, and the people that are winning are, the institutional investors, the prop traders, the banks, etc. And like all of the smart money, they know how retail traders think. They know that, people are putting stop losses below support or above resistance, or they're looking for head and shoulders and putting entry orders, below the neckline or whatnot. And so when you're looking at price action, you can really tell what the banks are doing. So are you familiar with stop runs?
Yeah, but just explain it for any of the listeners if they're not.
Okay, so a stop run is basically where, let's say you have a level of support and lots of people are going long, and no doubt there's lots of stop losses below that level of support. So what happens, if you go back to the basics, when someone goes long, there needs to be, in order to be filled, there needs to be like an equal sized trade going short. And so if you're like a big institutional, like let's say you're a big bank and you've got hundreds of millions, if not billions of pounds or dollars to play with, if you want to have a big position to go long, you can't just go long willy-nilly. You need to find sellers. And one of the easiest ways to, get sellers is effectively stopping people out, because when a stop loss is activated, that acts as or that sell side for you there, and so they can get filled. And if you look at a lot of sort of key reversals and whatnot, you'll always see some sort of spike into that level of support or resistance in order to stop everyone out, or to activate other entry orders, so to speak. Yeah, I mean, like the moment a lot of people listening to this can probably relate to this. Like when I was like inexperienced, it felt like the whole world was watching me every time I placed a trade. And the moment I went long, it's like everyone, he's gone long, let's all go short. And like there are times where I just place a trade and the market just bugger off in the wrong direction, like instantly. Okay,
and you mentioned a little earlier that another challenge you had when you were coming up was strategy hopping, and I think this is something that a lot of traders coming up also struggle with. You're definitely not the only one who struggled with that. What exactly is strategy hopping? Like, how can you kind of identify when you are doing it, and why is it such an issue?
Okay, so I suppose there's two ways when you can approach this. So if you're a typical punter, and I know you've gone on some forum and you found some sort of guru saying, you need to do this system or this, moving average crossover type system, and then you go along, you trade it, whether it's on a live or dummy account, and let's say it works for a bit, and you'll go, oh wow, I've found a really cool system here. So you then do this system, and then after a while you start losing, and because you don't really know much or have, much trading psychology or, risk management at all, you think, this was a waste of time. It must have been fluke. And so what you then do is you go back to, the forums and the, or books and whatnot, and you try and scour the internet for other systems. And that's an endless rat race type cycle, which I found myself in for, a good number of years. And anyone that's listening to this, if you're in that sort of cycle, please be aware of it. Now, so that's the bad way to go about it. Now, obviously, if you're starting out and you don't have a system, well, obviously you need to find a system. You need to find that sliver of an edge on the market. So if you're aware of obviously you need to test things. You can do some Monte Carlo testing or whatnot. I mean, there's only so much back testing can do, because I mean, there's a certain amount of curve fitting that you can do when you're trying to test out a new strategy using past data. But yeah, I mean, please, by all means, test out new strategies, but be aware that not every strategy is going to work all of the time. And this is sort of why I've I think, slowly migrated to swing trading and, technical trend trading, basically. I mean, this is just a matter of opinion, but I personally believe that trend trading works simply because it doesn't work all of the time. I mean, as I was saying, I think the other day to you, that when you look at the markets only trend 15% of the time. The other, all the other times they're either ranging or chopping or, just being horrible looking, so to speak. But when they do start to trend, they then have a high propensity to carry on trending. And trends do trend a lot longer than people think. And so if you can get on these these trends, I mean, there's a lot of potential profits to be made. And like, the way I look at things is that if you look at any, so I'm predominantly a currency trader, so majors and minors. And when you look at any sort of individual currency pair, more often than not, each pair will trend at least 1,000 pips, probably once, maybe twice a year. I mean, some more than others, because I like pound Aussie will have far bigger trends than, say, euro dollar, but it's the way that they're sort of geared. But and I now look at basically 20 different pairs that I have on my sort of radar. And it's just a numbers game for me. So I know that roughly 20 different pairs will trend in at least 1,000 pips, at least twice a year. So that's 40 different opportunities to try and jump onto. And really, I only need one, maybe 2,000 pip plus winners for me to have a good year. So I'm just playing a numbers game. And I mean, you've looked at my track record, or my reports, and you'll see that I'm flat most of the time, if not negative, because all I'm doing is I'm trying to get in these runners, and I get stopped out a lot, or so I may have 3 or 4 like losing or flat months, and then I have a big win. So I just make sure I have only 3 outcomes: small wins, small losses, and huge wins.
Yeah. No, I did see that, and I thought that was interesting. I've actually got a couple questions that I want to ask you around that. But before we do, you're talking about these big trends that happen in some currency pairs. How do you define a trend?
Okay, well, I mean, if you're trying to jump on a trend after it's formed, you're far too late, because normally the market's already moved like 200, 300, 400 odd pips. So you need to try and get in at the beginning. So what I tend to do, I mean, I try and so I'm a swing trader. I try and sort of get on the reversal. So this is a lot why I get stopped out quite a lot, because sometimes I effectively jump in front of that steam train, so to speak. But I do also manage to get in near the bottom or near the top of some reversals. So one of the key things I do when doing sort of support and resistance trading is that, like, if you're looking at any odd market, a currency pair or an index or whatnot, and you see a huge level of support. Let's say the market is coming down nicely, and you've seen, let's take the FTSE. Let's say it's it's hit the 6,500 level, and it's bounced off. So all of a sudden you're thinking, oh, okay, that's a key psychological level of support. It's a 00 number, and it's bounced off. And let's say it rallies a bit, and then it comes back, and over time it starts migrating down a bit. And it's now approaching the 6,500 level again. Now, in terms of support and resistance, what I've found is that level of support is its most strongest that second time round. So first of all, it's hit that level once, and the second time it hits that 6,500 level, I believe, is the strongest part. So what I would then do is put an entry buy order at literally on the 6,500 level. In anticipation that it hits that level again and then sort of bounces off, back north. And obviously I then have, support, stop losses and whatnot, below the 6,500 level, but I will also scale in. So I may put an entry buy order on the 6,500. I'll probably put another entry buy order on the 6,450, and also I'd scale up as well. So if it does overshoot and punch through the 6,500, which it will do, but then retraces, and let's say the market it can't close below it, so to speak. That's how I can get on the reversal. So I'm in the trade, and if it then starts going up, and 200-300 odd pips later, it's starting to form a bit of a trend. Well, you're in near the beginning, and I mean, obviously there's the standard definitions of trending, higher highs and higher lows, so to speak. But really, I just like to see the market break out from distinct levels of ranges. Really.
Okay. So a lot of the way you're trading is really in anticipation of a trend playing out, essentially. Yeah.
Yeah. And also you get the best triple R when you're doing that, because if, let's say, the market bounces off 6,500 and I know it's now shooting above the range and it's starting to break out, the market's probably already gone up, 200, 300, 400 odd pips. And if you then try and go long, on the breakout up, north of that, range, then, I mean, yes, you can still make profit, but ideally, I mean, where are you going to put your stop loss? I mean, ideally, you always want to put your stop loss far out of harm's reach. So, you'd like to put it below the actual range. So you end up having like a really big stop. Whereas if you're trying to anticipate the bottom of the range or the bottom of a potential reversal, you can afford to have a far smaller stop loss. So you could have like, a 150 to 250 pip stop, and then end up, bagging 1,000 pip or whatnot, and making, anywhere upwards of 1 to 5, triple R.
Yeah, so I guess the other side of that is you also get stopped out quite a lot. Your stops get hit very quickly, which then leads you to have quite a low win rate.
Correct. It's 32%. For me.
Okay. And, a lot of people aren't comfortable with this, or they find that difficult to actually stomach. And I guess that's maybe one of the reasons which kind of leads to strategy hopping, which we spoke about a little bit earlier. But how did you get comfortable with having a win rate around 30%?
Well, don't forget, by that time, I'd had years of unsuccessful day trading and scalping. And like one of the things that allures people, to these sort of day trading or, any sort of beginner or black hat strategy is that, do this system and you're 95% accurate, etc. And I was well aware that, you could make up a system right now, which is 99% accurate, and you'd have all these win. But when you had that loss, it would wipe out like a month or more worth of profit. And so I was well aware of, triple R and expectancy and whatnot. So, and going back to the question, what made me feel more comfortable is that, well, one, I'd just given up on, staring at the charts, 5 hours a day, etc. And I wanted something which is, I could just run and get on with my life. So I sort of came up, as I said earlier, I just sort of got into the mentality that all I need is 1,000 or 2,000 pip trades, and that'll make me, 10, 20, 30% per year. And I was just trying to play the numbers game. And even though because I'm trying to get on, I am literally stepping in front of the train a lot of the time, I only dip my toes in. So those first few, couple of entry orders that I'm, trying to jump onto the trend, I'm only going in at 0.25% max risk instead of, a lot of people go, 1% is, max risk. Well, I mean, if I kept going in at 1% max risk, I mean, I'd be destroying my account left, right, and center. But so all of these initial trades are 0.25% max risk, and then if I'm stopped out, well, great, well, I don't lose much, and I know that that trade idea is a dud. But when the trade starts to go in favor, I then scale in. So my second entry order, once it's going up, so probably 100 pips. Once I'm about 100 pips in profit. That will be about 0.75% max risk. And then all subsequent sort of scale-ins would be anywhere between 0.25 and 0.5 or 0.5% max risk. and I'm mitigating risk as we go along. So I'm like, for example, on the Black Monday debacle, I mean, there was, I think on the GOLDENFLOW, so on the DAX, I had about, whilst it was spiking down, I probably ended up having about 25 trades all on the DAX. And as it spiked down, it was just activating like all of my entry orders. I call them fishing nets, if that makes sense.
Yeah. So, that's interesting. How did you go about, or were you involved in trading what's just happened this week with the elections?
I haven't done too well, to be honest. So, like on my Facebook 6 months ago, I said Trump's going to win, and I'm expecting the markets to tumble. And so a few weeks ago, I sent out to some of the people that follow me. I'm setting up some positional trades, and I'm putting my shorts in now. Because we've been hitting all-time highs recently on all of these on the indices and whatnot, and I thought, right, I'm gonna get a positional trade in, and I literally I wasn't watching the markets because it was like 4 a.m. in the UK here whilst this was going on, and I was and I had a fair few trades open. I mean, not much. I mean, I'm down. In fact, I'm down 5% because of Trump. Because even though I got the direction right, I mean. The S&P did spike down, and I was massively in profit. I had a massive floating profit. What I didn't expect was it to rebound and then rally like an absolute mother.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
A lot of what we've been talking about here has been, actually, just before I get on to this next point I wanted to ask, you're talking about how you like to catch the really big moves. Okay, so you're taking a lot of small losses, just waiting for that big move to come along.
Mm-hmm.
Now, how do you anticipate when that big move is going to come along? Because obviously just trying to trade each reversal and that sort of thing, like the market is more likely to put in a big move at a certain point than it is off each, little reversal. So how do you, I don't really know quite how to word this question, but I think you know what I'm getting at. Like when is the market most likely to put in a big move?
So, well, the honest answer is, I don't know. No one's got a crystal ball, but what I do like looking for is coiling. So, well, basically, whenever we see a big move, what you'll find is that if you look at any big spikes like Black Monday and whatnot, volatility tends to sort of drop for some reason just before these big moves, and we see a sort of coiling in the market. So the range, the range of the candlesticks for the a week or a few days beforehand gets really small, and it's like it seems like it's a big spring that's being compressed, and then eventually it's basically market compression, and after compression is always expansion. And normally, you see these on flags or wedges or triangles and whatnot. It's all these patterns, these wedges and triangles are a form of compression, and you can see at the focal point that the zenith of the sort of the triangle is the maximum coiling, and then you see the release of some sort, and then you see a big spike. Now, I do like some sort of flags, where you see a real distinct coil, and you see really distinct levels of support and resistance in these sort of wedges and whatnot. In which case, sometimes you don't know the level, so you can straddle it, and then obviously you have your fishing nets above and below, so to speak. But also, I like really strong defined levels of or ranging, i.e. bullish and bearish rectangles. So if I see a huge downwards trend, let's say in a market, and then all of a sudden over a month or so, the market just hovers around a level, and it's creating like a nice 200, 300 pip range over a month or so. But when you're looking at the big picture, you can see that it's a big bearish rectangle. That is when I like to get in my shorts near the top of that resistance. And what you'll normally find with bearish rectangles is that when it does finally spike down to the downside, you will always see some sort of stop run. And that's where I get my shorts in. And so the honest answer is I don't know when it's going to happen, but when I see these really defined levels of support and resistance, I know something's going to kick off. Because the way I look at support and resistance is like, imagine you're by a lake and you pick up a soft pebble and you wing it across the water. Well, that pebble is going to bounce, isn't it? And every time that pebble connects with the water, it loses some kinetic energy, and it keeps bouncing and bouncing until it's got not enough kinetic energy to bounce, and then it just plops through the water. Well, I see the markets like that, and the more times the level is attacked, the weaker that level becomes. And so as I said earlier, the strongest a level is when the first or second time the market is smashing into it, and the weakest part of a support or resistance level is when the market is smothering it. Does that make sense?
Yeah, no, it does. And just a question based off what you said there. What's the difference between a bullish and a bearish rectangle?
Yeah, sure. So if you have let's say on the daily and weekly charts, you've got huge downward, momentum, and then all of a sudden the market stalls and it then starts going sideways, and then breaks to the downside. You can see it's created like a long rectangle, and that will be a bearish rectangle. And the opposite is for a bullish. So if you see a big bullet, rising market, and then the market sort of takes a breather for a few weeks or a month and creates a distinctive level of support and resistance, and then breaks to the upside, that is a bullish rectangle. And what a lot of retail traders do when you go on any trading website, and you'll see all these patterns, head and shoulders, double tops and whatnot. A lot of people trade them and get in way too late. So with a bullish rectangle, a lot of people get in when the market's breaking on the upside of these rectangle of the bullish rectangle, where in fact the most profit and the least riskiest time to get in one of them is on the bottom, is literally on the support level of that rectangle, because that way you have the smallest stop loss and the highest R multiple, basically.
Okay, so what defines a bullish and a bearish rectangle is depending on what side it breaks out of.
It's the overall trend of the market. So, for example, let's take euro dollar. If you look in the big picture, that's falling. No, let's go pound dollar. So cable has been falling massively over the last sort of 2 years, hasn't it? Well, and there is still downside pressure. So if all of a sudden pound dollar starts ranging, and over the next month or so, and it creates a really strong level of support and resistance, i.e. a rectangle, I mean, that would be a potential bearish rectangle. Does that make sense?
It does, yeah. Just moving on from that a little bit, a lot of this has been, it sounds as though you're a very technical trader. How important are fundamentals to you, if at all?
So in my overall investment sort of life, fundamentals are crucial. They're really important, but for my trading, negligible. Because I've just got a system. I stick to it, and it's just a numbers game for me. And I'm very technical. And the thing is, every now and again, probably once every 2, maybe 3 years, I'll be jumping on 1,000 pipper trade. And I'll be sort of 1,000 pips up, but it'll then turn into 2, 3, 4,000 pip trade. And when that happens, I mean, that single trade, I will be riding it, and I'll have, God knows how many positions on it. I may have sort of 20, 30 positions on that trend, and that one trade will make me sort of 2 or 3 years worth of profit. So that's all I'm doing. In terms of fundamentals, I use that for my overall investing. So trading is just one pillar to my financial parthenon, so to speak. And I believe everyone needs to sort of identify that they have a financial parthenon, whether they know it or not. And you need as many pillars as possible. So trading is one of them. Business needs to be other. You have business, properties, alternate investments, gold and silver, all sorts of different things. And so, especially for businesses and my sort of longer term investments, fundamentals are big. So I've got a lot of physical gold and silvers because of where the fundamentals are. Really, it's a safe hedge.
Got it. Okay. Yeah, I'm gonna ask you about all your business related ventures very shortly. Before we do, I'm just going back to this point about you trying to catch these really big moves, 1,000, 2,000 upwards pip moves. How do you actually manage a trade like that? I know you've talked about how you actually scale into it and that sort of thing, but nothing moves up in a straight line 2,000 pips. There's some really big retracements during that time. How do you manage those? Like, how do you know where you're going to get out if it continues and if it, starts to turn around, and how do you actually manage that position?
Yes, it's a good question. So when I'm in a trade, what I've learned is that you really need to make things mechanical, and the more thinking you do, the worse your trade will be. And so I do not like to top pick or bottom pick once I'm in the trade, because you're just going to scare yourself out. Especially when you're looking at the P&L, you'll see that you're not, 800 pips up, and you're looking at the pound, how much, the monetary amount you're up, and every bone in your body is going to want you to snatch, basically. And you're spot on. Things do not go up in a straight line. So the reason I love the daily charts is because, most people around the world are looking at the 1 minute, 5 minute, and hourly charts. But when you're looking at big trends, so 500 plus pips onwards, but long story short, I use 2 moving averages to monitor, to maintain my stop losses. So I used to be quite technical and have my stop loss in accordance with ATR and whatnot, but now I just keep it really, really simple. So simple trading is good trading for me. So I just plot an 8 and 21 EMA, and what I do is I will trail. So once I'm in a position, once I'm in profit, once I'm 100 pips up, I'll then start trailing the 8 EMA. And what I do is I make sure that I have a nice gap between the 8 EMA and my stop loss, and also a layer of protection in between that. So when I say protection, I mean like a 00 number or a 5 or a 50 number, because they are natural sort of psychological levels of support and resistance. And so as the market goes up, by the time it's sort of 250, 300 odd pips, because I'm trailing 8 EMA, I'm only breaking even by the time it's, a couple of hundred pips up. And what I then do is I keep on trailing the ATMA, and then when I've locked in 200 pips, so I mean this hurts. It really does hurt, because by the time I've locked in 200 pips by trailing the ATMA, the actual trade is probably 400, 500 pips in profit, and you're sat there going, oh, I'm only locking in half of that. And then so the 200 pips part is quite key for me, and then I then leave the stop loss there and wait until the 21 EMA catches up. And so that's even harder, because the market will carry on going in your favor. And by the time the 21 EMA is sort of caught up, like the whole trade may be 600-700 pips up, and you've only just started trading the 21 EMA. Yes, there are times where, the market, goes up 600-700 odd pips and then just pulls back or reverses. And, I've only bagged 200 odd pips or 400 odd pips or whatnot, and that can be really frustrating. But what I have found by trailing the 21 EMA, that gives you enough space from the market to trend. And just pull up a chart, get any major pair out, and look for any big trends and plot the 8 and 21 EMA, and you'll see that the market does always pulls back to the 8 and 21 EMA. And yeah, as long as your stop loss is below, the 21 or above it, if you're shorting, you'll be fine. And then eventually the market will, reverse or pull back into my stop loss, and I'll be out. I mean, there's zero thinking involved. And so I literally spend less than 5 minutes a day trading, because all I'm doing is I'm looking for my setups. If I see none on my radars, I don't do anything. And if I've got some positions, I just smidge up my stop losses by every other day or so.
Right. Now, you said your trading takes you about 5 minutes a day, and this is something I was going to ask you about, because you'd mentioned it the other day when we were speaking. That's going to sound really absurd to some people, that you spend no more than 5 minutes a day trading. I don't know what question to ask first, but like, is that realistic for someone who's still finding their way as a trader?
No, definitely not, because I'm a firm believer that you need chart time. I mean, we've all heard that 10,000 hour rule, where, it takes 10,000 hours to be good at something. I think it's actually a lot more than that. I mean, you can do 10,000 hours of, something and still be pretty shit at it. So it has to be quality time. And I think I've had well over 40,000 hours of staring at charts. And so it gets to the point where you can look at a chart and, you can see all, the price action, and you get to understand price action a lot more. And so when you're starting out, you need chart time, basically. You need to understand price action, because like I have basically two moving averages, the 8 and 21 EMA, and pretty much that's it. I mean, I may have a sort of another indicator to help me get in, but I and that's it. So yeah, to begin with, when you're finding your feet, you need to put in the time. You need to read the books. You need to read everything Van Tharp has kindly made, and all the other and the Market Wizards books, etc., and really get into trading mindset, because that is everything. But for me, I mean, I am of the opinion that, like, I personally, I know that I'm going to trade until the day I die, simply because it doesn't impede in my daily life. Whereas we are all busy, no matter who you are, what you do. I mean, we all, have a job or a business of some sort. And then, if you have to come home and, feed the family and walk the dog, and then have to spend like another few hours staring at charts, it's going to get in the way of your personal life. And that's why a lot of people, they may start getting into trading, but, 3-6 months down the line, they just give up because it takes too much time. Whereas if something takes 5 minutes a day, well, you're far more likely to continue doing that. And so I've just got a set routine. I wake up whenever I wake up, and I sort of stumble into my office in my dressing gown. I load you don't need multiple screens, but I've got 3 screens, and I load up my sort of radar, so to speak, and that is something I've sort of developed myself, and I just look for potential setups. So this radar is effectively like a tiny. I'm just looking for a certain sort of indicator, so to speak. And if I see a potential one, I'll then open up a proper chart and have a look at it. And I've got a rule that if I've got to think more than sort of 3 seconds about it, I don't place the trade. If I've got to think about it, it's not a trade.
Yeah, I like that. That's actually, I interviewed John Carter on the podcast. I think it was like episode 69. And he said something very similar. He said, I'm going to butcher it, so I'm not going to bother. I'm just going to link to it in the show notes. But yeah, he said something very similar to that, which makes a lot of sense. So this radar is essentially like a scanner of some sort. Like that's really what saves you a lot of time.
Yeah, massively. And I'm getting quite lazy actually, because I'm actually about to get a trading assistant. So I'm going to get another PA, and that person's going to also do my scanning for me. So the plan, I'm literally probably a week away from getting this. I'm doing the recruitment as we speak. The plan is for that person I'm going to teach that person, my methods, etc. And then every day, or in fact, look at the charts a lot more than I do, and get that person to look at my radar. And then if there is a potential setup, by the way, every time I see a potential setup, in order for me to place a trade, I'll go through about 10, maybe 20 potential setups for me to actually place a trade. And so I'll get this person to go through the radar. If there's a potential, look at the big chart, like a proper chart, and see if it's a goer. And if it is a goer, what I'll do is I'll get that person to, WhatsApp me or they're going to be in the same building. I'll just say, Simon, here's a setup. I'll then have a look. And then if I say, yeah, it's a goer, I'll say, right, place the trade for me. And that person will know, what to do next. So I'm just trying to leverage everything in my life, everything from time, money, assets, resources, everything. I'm just lazy, basically.
Well, no, I think that's a good thing in some ways. That's what you got to do to scale. There's a quote by, is it Bill Gates? Something around that, how he'll always hire the laziest person over someone else because they'll find a quicker or easier way to do it or something like that, which I think is maybe relevant to this.
Yeah, I've got a concern about what I'm going to do though. So it'll be interesting to hear the feed on this, because this is sort of an ask from my point really. So one of my concerns is if I do this and fully outsource my trading, I'm going to lose touch with the markets simply because I'm not doing any looking. And one of my rules is that, if you go abroad on holiday or you're traveling, I purposely turn the charts off. I do not trade at all, because for me, it's imagine you're in the cinema and you're watching a movie, I know, the Avengers or whatnot, and you can sort of, you get the storyline. Normally it's not that complicated, but let's say you've got to exit the cinema for 20 minutes to take a phone call. When you get back in, you sit back down, you're going to be like, what the hell has happened? And it's going to take you, 10, 15 minutes to catch up with the storyline. And I think the markets are very, very similar. Yeah, so I think if you do go traveling and whatnot, you should trade very small position sizes, when you get back, just to get your eye back in. And I'm actually worrying slightly that by outsourcing things, I'm just going to lose track of the markets.
All right, so we've spent a lot of time talking about trading. And obviously that only takes up a small portion of your day. What's the rest of your day made up with? Talk to us about your life as a businessman.
Okay. So to begin with, the only reason I love business is because I've scoured the globe, all its asset classes, and I'm of the opinion now that the asset class of business is by far the most lucrative and best ROI or best, triple R business or asset there is by far. I mean, if any of my businesses don't grow 50% in a year, I'm pretty pissed off, to be honest. Whereas, can I make 50% per year on my trading account? No, not consistently anyway. And so over the last 5 years, I've been getting into business, but really over the last 3 years, I've been really dedicating all of my time into it. So I've got about 15 businesses now, 5 of them I've started up myself, so they're my sort of babies, so to speak. But I've been really getting into mergers and acquisitions, and like the ROI on that, like for like the ROI cash wise and also time ROI is just like it's unlike anything I've ever seen before. And so all I'm doing is what I say to new traders is that they need to ignore all of the hype that they see on Google, because trading categorically will not make you rich anytime soon if you don't have any capital to begin with. Whereas most people think it will, when it really won't. I mean, you can be busting out 20-30% ROI years every year, but if you're trading a 10 grand account, it's not going to get you far. So you need the capital. I mean, capital is crucial with trading, as you can imagine. So all I'm doing is I'm siphoning all of the dividends I'm getting through the businesses are all flowing upstream to my holding company, and I'm just siphoning all the profits from my businesses into my trading account, and then I'm using trading as sort of like my computer is like a cash machine. It's like a compounding interest machine. And when you look at lots of rich people around the world, you'll see most of the billionaires out there have not got rich through, gambling or trading, whatever. It's through business. It's by, setting up, running, growing, and then selling the business. And when they get that huge liquidity event, they then, by default become investors. And so no one really ever got rich through compounding interest. That's sort of this, marketing myth. They go, oh, make 10% per year and in 40 years you'll be rich. Well, who wants to be rich in 40 years when you can't do anything? So yeah, I think you need to use compounding interest to grow your capital and, exacerbate the returns that you get, if that makes sense. So I've just realized I haven't actually answered your question. So yeah, the day in the life is, I suppose, like the day in all I'm doing every day is just, or I don't even run the businesses anymore. So I like to utilize other people's time. So I have people, i.e. staff that run everything for me. And I mean, a lot of people poo-poo staff and whatnot, but I think they're the most important assets of a business. Like, they are the most important things in any business, which your staff, and you've got to look after them. And like, when you're first starting up in business, you're literally clueless, just like with most things really. And you're the salesperson, the accountant, the sales marketing manager, the customer relationship manager, the bookkeeper. You literally have to do every job, and what you get tied in to, you get right down into the weeds, and you end up working in the business when in fact you need to be working on the business. And that's so crucial. You have to work. I mean, this can apply to everything. I mean, you have to work on your business or on whatever it is. So I'm of the opinion now that, I mean, if anyone else is listening to this and you are a business owner, you need to get out of the weeds. I mean, if you're still doing the bookkeeping or the cleaning or anything like that, you need to get out. And if you're doing anything other than looking for JVs, a business to buy, or strategic partnerships, you're in the weeds. So literally on a daily basis, all I'm doing now is just trying to find companies to buy.
So what was your first business?
Well, I had a few that flopped. So my first 2 or 3 businesses failed miserably. So do you want the first flop or the first sort of successful one, or?
I'd like to hear about both.
Well, like most traders, you get into the whole, journey of financial education. And, when I started realizing and finding out things about, fiat currencies and how the global financial system works, and, how, things like the Federal Reserve is, a private bank owned by private shareholders, and, all those sorts of sexy things, etc. I was like, wow, the average Joe has no idea about this, or, how interest rates worked, etc. So I set up a website called hownottoloseyourshirt.com. And I think I was selling, this really crappy e-learning ebook or online course, just basically how the world works. And I think I got 10 people on board, and then, yeah, I just had to wind it down because it was just sapping up way too much time. So that didn't work. So this is all when I was stone broke, by the way. I was trying to just do anything to get out of my crappy admin job. I was known as toilet boy in that job because like I used to literally I used to work on my business, my part-time businesses during the lunch breaks when I wasn't at work, and I used to go to the toilet like 10-15 minutes at a time, and I would just be sat in the cubicle, just like not going to the toilet, but just sending out emails, invoicing, and stuff like that. So I apologized to the manager when I left.
So what was the first business that got some traction and started to take off a little bit?
I was a bullion dealer actually. So obviously, I was a big fan of Robert Kiyosaki, and then I found Mike Maloney and all people like Jim Rickards, Chris Martinson, and people like that on YouTube and whatnot. And I found I started getting into gold and silver because I really do see. I mean, especially with silver. I mean, it's the second most used commodity on the planet. All electronic needs it, and the world's running out of it. And I thought, wow, this is such a huge fundamental play, like a medium-term play. And I started trying to find out how I could buy bulk silver, to get it cheaper. And I found, I didn't know how big they were, but I managed to come across Europeans' biggest bullion dealer through a networking event. I met their MD in London, and I was saying, I need to get into this. And he was like, well, if you find if you place orders over 100 grand, you can get some really great discounts. So I was like, okay, well, I then put a Facebook status out saying, I'm buying a load of silver. Anyone want to chip in? And like my first order was about 100K, over about sort of 10, 15 people. And I then did that same status like every month for the next 3 or 4 months. And I was like, wow. And so I managed to get silver for myself really cheap. And then basically a bullion business. I became a bullion dealer by default. And yeah, that was a pretty it was successful, but it was painful because the net margin was 1.4%. So in my first year, I turned over 1.4 million quid, but yeah, made like under 20 grand net profit, which was just horrendous for all the hours I was putting in. And so, yeah, after about a few years, I sold that. And then, yeah, that left me with, because I had a database of, paying subscribers, so to speak. So I managed to sell it for a nice sum. And then I used that capital to start some other businesses, really. And I put a whole whack of it in my trading account. Yeah,
right. So how have you gone from having one business to now having 15 businesses?
Well, I set up, so I sort of redid my, hownottoloseyourshirt.com sort of business, and had an education company, and that did well. So I had created sort of a following that way. And about 3 years ago. Oh yeah, so I started some other businesses I had like a consulting business I set up. I set up an aviation brokering business. I mean, that did well, and then it did horribly bad, so I had to shut that one down. But like anything, I sort of muddled my way through. But about 3 or 4 years ago, I did this mergers and acquisitions course in Mallorca. And there's this guy who, shall I say his name or not? I don't want to plug anyone, but basically he's one of the world leaders for mergers and acquisitions. And I got one of his sales emails. It was like in the spam folder. The subject line caught my attention, and it was a really long form. I mean, it led me to a long form sales page, and I'm like a salesperson's wet dream because I just buy everything. I'm easily sold to. And by the end of that, I read it all. I pressed buy, and it was a £7,000 course for 2 days in his home in Mallorca. And I told my wife, and she was like, "Oh, you muppet, Siam, you've been you've been had." And I was like, "Yeah, I probably have, but I mean, if I can just get one nugget." So with every conference I go to or whatever, all I want is just one nugget which I can go away and do. And so I went there with completely open-minded, and to be honest, I stumbled onto some apps like a gem. If that course was 100 grand, it would still be dirt cheap. And he was a legitimate guy. The course was great. I mean, and I learned everything from how to buy distressed businesses, how to buy successful businesses for £1, how to, basically buy and sell businesses. And like that course was the beginning where I realized that like there is no profit in running a business. Like it was quite interesting. Like the first line, but there was about 7 other people there, all business owners. And his opening line of the weekend was, all business owners are mugs. And we were all sat there looking at each other going, wait a minute. Yeah, we probably are. We just paid you $7,000 and you're calling us a mug. And then he went on to explain that basically, like, there's no profit in running and growing a business. That's where all the heartache is. That's where, you know, all the growing and teething problems are, staff problems and, you know, getting to market, and it's costly. And like businesses, like trading, is a huge marathon. And most people like fail like in the first or second hurdle. I mean, in business, 9 out of 10 businesses fail in year 1, and those that succeed year 1, another 90% fail within year 5. And so it's like, like hardly anything emerges from, you know, 5 years. And so basically the idea is that I don't like buying businesses that are up for sale, because there may be skeletons or they may be selling for good reason. So I like buying businesses that are not looking to be sold. So I like nice profitable businesses. And it's like, you know, chasing the girl at school. You always wanted the girl that you couldn't get. And it's the same with these businesses. And so I've got a criteria. So I only buy businesses that have been running for at least 3 years, have at least $300,000 net profit per year, and have like a management team in place. So proper, you know, staff. So that way, when I acquire it, I can put like my own MD in, or I can promote the person, you know, like the ops manager in, you know, to run the company. And then I can sit back and just get the dividends. And there are certain ways you can get the company for cheap, or do like a thing called a bimbo, which is a buy-in management buyout, where you effectively use the company's profits to buy the company for you. So yeah, that's basically it. So really, I mean, I own about 15 companies, but I only really actively manage or really run sort of 5, and they're the ones that I set up just because they're my sort of babies.
Okay, so you might have already answered this to some degree, but why not just have one business and grow it as large as you can, over having many smaller businesses?
Yeah, it's a really good point. And like some of my business mentors in the past said I'm a bit of an idiot for basically spreading my attention and time and energy, you know, everywhere basically. And I mean, it is a really good point. I could just focus on one thing, but I'm also trying to mitigate everything. So I do not like risk. So I mean, as you can probably tell with trading, I'm going in at 0.25% per max risk per trade. I mean, so if you just have one business, you are susceptible to that industry. If someone disrupts that industry, you're screwed. If that one company is, you know, based in the UK and we have something like Brexit or whatever, I mean, you can be screwed. So I have a very negative outlook on the world. And I had this, so years ago, I said to myself, for the rest of my life, politicians will always be crooks, bankers will always be bastards, prices will always be too high, taxes will always be too high, the government is not there to help you, and all the government cares about is being re-elected every, you know, 3-5 years or whatever. And so when you have that outlook on the world, you just think, right, okay, well, no one out there is there to help you. So I refuse to be the victim. So what I've done is I'm trying to just design my lifestyle. So I'm trying to design it so, one, I don't need to go on holiday to escape from my life. I try and make my life every day, you know, a holiday, so I don't need a holiday. And also in terms of financially, I want to be completely hedged. So, I've got, you know, gold and silver, you know, I am hedged. And in terms of businesses, I mean, the businesses range from engineering, IT, recruitment, marketing, education, training, manufacturing. So like if the shit hits the fan and, you know, Donald Trump, Brexit combined with China going bust or whatever, yeah, maybe a couple of the businesses will go bust, but will it hurt me? No, not really. I mean, even if I lost all my businesses right now, I would still be financially independent. And so, yeah, I'm probably missing a trick by not putting all my focus on one thing. But I mean, I'm just doing this M&A thing right now, and I'm getting into IPOs quite a lot now. So there's some huge, like, like buying stocks and shares is so 1990s. It really is. It's like you got capital gains tax, you got stamp duty, you got commissions, and like as you know, most people, like most retail people, are dabblers. People are, most people that trade or are on the market are dabblers, and I mean, the high frequency traders have got the markets licked. They really have. The stocks, that market is licked, and they're now seeping into the high. So the HFT firms are now seeping into the currency markets. I mean, as you know, it's the world's biggest market. So I only do pre-IPO stuff. So for example, there was this this company which IPO'd in July. It IPO'd at €1, but I got in at 50 cents a share. And so the day it listed, I made 100% ROI, guaranteed, and it's now sat at €4. So, I only touch stocks if I can get in before the crowd, so to speak.
Right. Okay. No, that's a really good answer, and I think you did a really good job of explaining that too. Going back to a point you made earlier when we first started talking about the business side of things, you said that you're not going to get rich from trading alone unless you have large amounts of capital. That's a fairly reasonable point to make.
Yeah.
And then you further made the point of saying that that's why you go into business, is to, make larger amounts of money, which you can then put into your trading account, and they kind of tie in together. They kind of work as one in some ways.
Yeah.
How do you actually suggest someone goes about doing things that way? Because we've got to think that if someone doesn't have a business already, they probably are employed. If they're just starting out in trading, it's likely something they do after hours.
Yep.
They've now got to try and fit in starting a business and getting that off the ground. Like, how doable is that?
I always put my money where my mouth is, and I think it's really doable. But the thing is, when people think of business, they think, oh shit, I need to create the next Uber, or I need to create the next Amazon or Google or whatever. And no one ever got rich, really. I mean, unless you're Mark Zuckerberg, you don't have the one-hit wonders are like unicorns. They really are. Wealth is not made in one magic bullet. It's through it's the compounding of lots of toil, heartache, and effort. And you shouldn't. Your very first business, you must not think it's going to make you millions. I have this game which I play with myself, and I call it the 5 to 9 game. And years ago, this was literally 5 years ago, I was half drunk when I came up with this with my friends, and I said, right, I'm going to sell a business for 5 figures, then 6 figures, then 7, then 8, then 9 figures. And so that's what I'm doing. I'm the first business, yeah. So I've sold a business. I'm on. I've just done a 7-figure exit, or I'm literally in the paperwork right now. So my next number is I want to sell a business for 8 figures. And the thing is, every time you do that, you learn your skill set in business gets massively improves, and you start playing at bigger levels, so to speak. But going back to what you said, which I think is a really good question, the average person is in employment or whatnot, and I think, first of all, there's 2 things here. First of all, you need to change your view on trading. You must not think that trading is going to get you out of your financial hole if you are in one. Because what you need to do is you need to work on your skills. Don't worry about the money. Just you need to make it so that 100% in your gut that you can trade an account consistently and profitably and make even if you're consistently making it, 7-10% per year, you're already in the top 1% of global traders. And if you, and what I say is that if you can create a track record of at least 2 years of solid stats that prove that you have minimal drawdown, that you're consistently making 10% per year, etc., you can then go and around and flaunting that, that track record. Hell, get it audited by an accountant, so it's proper legit, or do it, trade through, MyFX or whatever, any online sort of logging software. So it's all legit. And then there are people out there that will be willing, like prop firms or banks or whatever, raising capital will be a lot easier. Now, obviously, you've got to be careful of, regulations. You can't be, doing money management without the proper sort of stuff. But you just need to get to the point where you can trade an account and grow it by 10-20% per year. Because when you can, then it's all about scale. It really is. So that's the first thing. So over time, over 3-5 years or so, just work on being a good trader, even if you have a tiny account. And definitely use a live account, not dummy. You need to do all of this on a live account. So that's the first thing with a trading mindset shift. The second thing is, let's say you're making 10% per year consistently. Well, you then need to know what you want to live off. So let's say you want to make, 200 grand a year. Most people could happily, retire on 200 grand a year. So, well, at 10% per year, you need what? 2 million quid, right? So you then need to start thinking, how can I make £2 million in a lump sum sale? So obviously, because I'm going down the business route, I mean, it could be property, it could be all sorts of other things, but I go down the business route. Well, I need 2 million quid. So I've just got my calculator out here on my phone. So I'm typing in, 2 million quid. Now, I would basically look for a subscription-based type business. And the reason being is that if you have an automated business, online business, which has subscribers paying you money, you have a really good exit multiple. So what I mean is that you can sell your business for 10, 15, maybe 20 times EBITDA or profit. So what that means is, let's take 15 times profit. So if you want to sell something for 2 million quid, in fact, let's call it 2.5 million quid, because after taxes, etc., you're going to be screwed over. So let's say you need a 2.5 million quid exit. Well, let's divide that by 15. So that means, let's assume that you can sell this business for 15 times earnings. Well, that means you need a business that chucks out 166,600. So let's call it 170 grand a year. So you need a business, automated subscription type business that chucks out 170 grand a year. Now, so you've got to work backwards, as you can see. So now we got this figure. I need a 170k business. So what I would suggest is that you find a product which has mass market potential at a very low price point. So, for example, you could sell something at, I don't know, £21 per quarter or $21 per quarter. I'm going to stick with pounds because I'm British, but so £21 per quarter. So that's what, £7 per month. What's that, like 30 pence per day for the actual user. So you then need to work out the lifetime, the yearly value for that customer. So if they're paying you 21 quid a quarter, that's making you £84 per year in terms of revenue. So if you do 170k divided by 84 quid, that means you need 2,023 people paying you 21 quid a quarter. Now, obviously that's revenue. So let's call it 2,500 people. I'm always round up. Hell, let's be even more conservative. Let's say 3,000 people. So you need 3,000 people paying you £21 a quarter or £7 a month. And then you can sell that business for 2 million quid. You can then dump that 2 million quid in your trading account and then live in Costa Rica forever or wherever you want to go. And like most people work a job for, 20, 40 odd years. Well, hell, do you think if you had a business with a product or a service where, do you think over the space of 10 years or even 5 years, you can find 3,000 people to pay you 7 quid a month? I'm pretty sure you can. And the beautiful thing is, with a product that's, 21 quid a quarter, it doesn't have to be all bells, singing, dancing, whistles and gadgets. I mean, I'm not saying, deliver shit. You must never deliver shit. I mean, money is a byproduct of value. Please, you must remember that. But the thing is, once you have that database, let's say you have 3,000 people paying you, 7 quid a month or whatever, and you've created your own printing press because you have 3,000 people that effectively trust your product or service. So all you need to do is come up with a new product and go, hey, here's a new product. And guess what? It's, the same price. Or hell, you then just basically created another £2 million business. So a prime example of this is, dollarshaveclub.com. Yeah. Well, they started off with, really cheap razor blades. And they've now sold for billions, by the way, but they had that. And then once they had that following, they then created a new product line called, I think, One Wipe Charlie's, which is like a toilet paper type thing. And then nearly all of their customers became customers of that new toilet paper. So he then doubled his business overnight. Does that all make sense? I've sort of gone on a massive, rant there, but all work backwards.
Yeah. No, I really appreciate you breaking it down. I think that's really insightful and super interesting. One thing we should probably factor into those equations is churn as well, because,
Oh, yeah, definitely. Always round up. I mean, realistically, you probably need 5,000 people paying you 21 quid a quarter. But and also it depends where you exit, because if you get a private sale, most private sales will be done, they'll be like, yeah, we'll give you 3 times earnings, or in this case, 15 times earnings, etc. Well, if you sell to a PLC, so another stock market, publicly listed company, a lot of the time they'll try and acquire a company because you're, one, probably taking their market share, 2, they see you as a future competitor, and 3, they'll try and get you to bump up their revenue. So I've got a friend who sold his oil company, and he went into the meeting, the final meeting, he was like, right, I'm not going to accept any less than 5 times EBITDA, so profit. And he was saying that at this meeting, there's just him on his own, and on the other side of the table, there's 9 people. So there's the main guy and like 8 solicitors or accountants or whatever. And they're like, I won't say his name, Mr. Blah, we're prepared to offer you, we're going to have to be quite reasonable. We're only prepared to offer you 21 times revenue. And he was like, right, keep cool. And like under the table, he was like, yeah. And yeah, so they're trying to buy 21 times turnover, and all he wanted was like 5 times profit. And so he walked out. He sold it for 25 million quid.
So why are people willing to pay 15 times for subscription model based businesses?
Yeah, again, another good question. Just so put yourself in the investor boot. So what was it? 170k revenue. So let's say it's making, I don't know, call it 120k net profit. Yeah. Going back to that business example with the 3,000. So if a business is making 120k net profit a year, let's say I'm an investor and I'm going to buy your business that's making 120k net profit, net after tax, and I give you 2 million quid for that. Or just work out the yield. So 120,000 divided by 2 million equals 6%. So just by buying that business from you at 15 times profit, that business is going to make me 6% divvies per yield, and 6% on 2 million quid. It's not hard. I mean, it's good, and that's sorry, I'm stuttering now, and that's assuming sales remain flat. So let's say I'm buying that off you. I'm not thinking, right, I'm going to buy this off you and I'm going to keep the subscribers at 3,000, people. I'll be sat there going, right, I'm going to buy this, make you happy, give you 2 million quid. That's 15 times earnings. That's instantly made me, a 6% yield, and I'm going to, double the amount of subscribers. So all of a sudden that asset, which I've now bought from you, is now making me 12% per year. Does that make sense?
Absolutely. Yeah.
Yeah, just always put yourself into the boots of the investor.
Right. Yeah, I'd never really thought about it like that.
Yeah, and also automated subscription is the way forward, because you don't need a big business with lots of staff. So like if your whole business is automated, and everyone's on a direct debit, that's music for an investor's ears.
All right, so just moving on from this, the last thing I want to pick your brain about is the schooling system. I know you're very passionate about this. Talk to us about your views on the schooling system.
So I'm going to have to condense this because I can talk forever on this, but I did a TEDx talk on this topic earlier this year, and I basically believe that schools are killing our kids, like mentally. I really do, because our schooling system was, derived from the Industrial Revolution, where it's designed to send as many kids as possible into the factories. because we were going through that huge industrial revolution. And the thing is, nothing's changed in the last 150 to 200 years. And what it's doing is it's setting, like at the moment, all schools are pretty much promoting the 40-40-40 plan. Work 40 hours a week for 40 years and then end up retiring on a pension 40% what you struggled to live on in the first place, which is the worst plan ever. I mean, why work for 40 years when you can realistically bust a gut and retire in 5, maybe 10 years? Those days are gone where you just work in a job forever and get a really big fat pension. And so we are right now going through a technological and entrepreneurial revolution, and robotics is going to wipe out vast amounts of jobs, waitresses, factories, you name it. The law world, I mean, paralegal jobs will go because, I mean, the computer's more accurate now. So there's so many jobs that are going to, disappear through tech. And if you have a schooling system, I mean, tech is on an exponential growth. Yet our schooling system is still kitting out kids with bugger all skills. So what I'm in the process of doing, my son right now, I mean, it's now, November 2016. He's 5 months old. And I simply do not trust any school in the UK for my son to go to. Because I know they're just going to beat the creativity out of them. So I'm in the process of setting up my own super school. So financial education will be the number one topic, because as long as humans are around, there will always be money, currency markets, stock markets. So you need to understand the world financial system. So that will be a big topic. But also, my kids will, as in the kids that come to my school, will know that, they can be or do anything. They don't have to just settle into a job. And so the whole school, from 5 till 18 will gear them up into becoming a business owner. Because business owners are the backbone and the bedrock of society. Really, they employ the most people, pay the most tax, percentage-wise anyway. And worst case scenario, let's say you keep on screwing up, well, you can always fall back and get a job. So money is not real. Money is just a concept. I mean, we're the only animal on this planet which has money. And it's no different from, monopoly money or, a glass of water. It's just people's perceptions and beliefs around it. And it's just, I think it's not a real thing. So what you need to do, I mean, if you are in the position where you are wealthy and you are rich, I feel it's your moral obligation to the world to convert that paper, which is all it is, paper or ones and zeros in a computer, convert it into something real. I help with the environment, or create charities, or you do whatever, at the very least, try and become carbon negative. So yeah, that's my thing. I mean, what I really want to do is change every school in the UK. And it's going to take me 50 plus years. But I mean, if I can create just one school, I'm happy, because my son and my children will go to that school, and I know that they'll do far better than the average person leaving the average school. So maybe being a bit big-headed here, but it's my plan anyway. No,
I mean, I'm totally in agreement with you. I think the schooling system is broken for sure. I mean, there's no doubt about it. You can't say otherwise. So you mentioned that there would be a lot more subjects around finance and, the financial world, which obviously I see value in that. What other subjects would you want to teach more of and perhaps less of?
So, I mean, less of the things which are completely useless and irrelevant for, everyday in life. The parents for these kids that come to my school, I mean, if their parents want their kids to be a doctor or an engineer or a mathematician or a scientist, this really isn't the school for them, because for that you do need good grades, etc. And I don't think I will have a proper grading system. So I think, financial education, we're going to have our own currency system within the school. So it'll be a fiat currency. So, if the kids can become a millionaire or a billionaire within our schooling system, when they leave into the real world, they're like, well, I did it, with school money. I can do it with, sterling or dollar or SDR or whatever it may be back then. But coding, I think, is going to be a huge thing. So at the same time, I'm going to self-fund this, but I want one of the UK's best centres for 3D printing, robotics, virtual reality and augmented reality. And what I want is for these kids to play around, create stuff, break stuff from the age of 5. And what I'll do is that, like, if a kid is playing around with all of this kit, 3D printing, robotics, and, augmented reality, by the time they're 18, they're going to be really clued up. They're going to be creating all sorts of stuff we can't even imagine right now. And what we'll probably do is, the school will keep 50% of whatever business they create, and they keep half. And I don't know, I genuinely believe this school will create the next, Elon Musk or, Zuckerberg or whatnot. But at the same time, just real stuff, things that you need in everyday life. Like, I've never in my life needed Pythagoras or trigonometry or algebra.
Yeah, going back to what we're talking about here, what sort of challenges are you going to come up against in doing this? Like, I don't imagine that starting a school of your own is any easy task. What are the sort of challenges? Like, I'm sure there's some sort of regulations by the government and that sort of thing. Like, how do you plan on tackling that?
So, there's going to be quite a few regulations or challenges. So, luckily in the UK, there's a thing called a free school. So you can create a school with, and do effectively whatever you want, so to speak, or within reason. I mean, look at school holidays. The only reason we have 6-week or 8-week holidays in summer is because of harvest. Not many people know that. Like, the only reason we have these huge summer holidays is because the farmers back in the day needed, their kids, to help out with the harvest. It's silly. I mean, I found a school the other day that did 6 weeks on, 2 weeks off, all year round. And that seemed like a far better solution. But so regulations, there will be one. Funding is going to be another one. So I've worked out I need at least 10 million quid to do all of this thing, everything that I need. I want to buy, at least 100 acres of land so I can build stuff on it, and get the kids to build stuff on it, etc. And the thing is, if I get government funding or external funding, all of a sudden I am like a puppet of, the fund managers or whatever. So I want to completely put every penny I have into this. So hell, it may be like a dictatorship. But the thing is, I don't have all of the answers. I'm a simple bloke with average qualities from Norwich in the UK. I'm a very average, and I don't know. I mean, when I did this TED talk, it was full of educators in the room, and it was so Marmite. Literally, half of the teachers in the room hated my guts, and half the teachers in the room loved it. Another thing is that I'll put the minimum wage for all teachers at least 60 grand a year, minimum, because I don't want a teacher that has debt problems and money worries looking after my children. I want them to be 100% focused on my kids, not their mortgages or whatever. So teachers do need to be paid more, because they're like, your kids are the most important thing in your life. But the thing is, what I'm going to do when I fully press the go button, I'm going to pay the best minds in the world. I'll find the best, forward thinkers. I'll get the best business people I can find. I'll get, some of the best teachers and whatnot. Sir Ken Robinson is high on my list. If you haven't heard of him, read his books or just YouTube Sir Ken Robinson. He is amazing. And I want to get like 20 odd people, the best people in the world, into a hotel room and go, right, I'm going to pay for all of the expenses and go, right, for the next 2 weeks, you are not to leave here until you come up with the new blueprint for the best schooling system that will gear people, kids up for the next 100, 200 years, and no doubt it's going to be tech, led and whatnot. And so I don't know what that blueprint is, but after this big conference, I'm pretty sure we'll have a really good idea of what, a few possible blueprints could look like. And once I've got that blueprint, I can then implement it. I mean, I just use my business skills and whatnot. It's I'll just treat this like a new startup business. Yeah. So the first step is literally getting the best minds in the room, and forcing them to come up with, ignoring all procedures and the norms and whatnot. Just go, right, if there are no laws, money's not a problem, blah 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 blah. What would be the best system? And once I've got that blueprint, I can then do stuff with that.
Sounds like a solid plan, man. That's big. That's big.
Fingers crossed. I mean, it's probably. Well, I've got a hard deadline. I've got to get this school set up over the next 4 years or 3 years before my son is, schooling age. But I mean, to affect other schools, it's gonna be probably a lifelong mission for me personally.
Sure.
So.
Yeah. I mean, this whole, what you're doing here is pretty major. A lot of people, like, you say these things, and I can just tell that you have a lot of confidence in what you're saying, and you genuinely believe it. A lot of people don't have the ability to think that big. Is this always something that's come natural to you?
No, not at all. I've had to I have to beat myself into this. So one, yes, I will fail massively along the way. I just know that. But the thing is, you're only a quitter when you give up when you fail. So I think I'm just stubborn. The worst thing someone can say to me is, you can't do that, or it can't be done. Because I'm always like, well, why not? Why the hell not? Normally why the F not? And the thing is, you just got to, in the Air Force, we have a thing called do, review, apply. And literally, that's all I'm doing in life. I'm just doing, I'm reviewing, and then I'm applying, the things that I fall up on. And the thing is, a lot of people, when you're setting goals, goal setting, motivation is temporary. We've all set, New Year's resolution to lose weight on the 1st of January, but by the 15th of January, we're on our 3rd Big Mac. And so the thing is, you need to focus on your habits, not the actual goal. So if you want to, let's say, lose weight, don't focus on, losing weight or whatever. You need to focus on the habits that will make you lose weight. So a habit may be, right, I will go for a 20-minute jog every single day. And you need to force yourself to get into the habit of doing that jog every day. And then you simply, successful people are simply the accumulation of good habits. I'm no different than anyone else, except I think I've just got better habits than people because I'm just stubborn. And also, when it comes to thinking, if you haven't read the book Think and Grow Rich, you really do need to do that and read everything by Napoleon Hill. I was going to say Napoleon Dynamite there. Napoleon Hill. So, and thinking big and thinking small takes roughly the same amount of time, roughly the same amount of energy, but it's so convoluted in the thinking small world. Everyone thinks small, and so it's so convoluted. So just think big. And there's way less competition. And then you also need to change the types of questions and also the quality of questions you ask yourself. So you need to condition your brain every single freaking day to say, what must I do to get this? What needs to happen to get this? Or what needs to happen so I can buy that Lamborghini or whatever? And nothing's going to change straight away, but eventually your brain's going to go, oh, okay, well, you'll wake up and think and realize we're swimming in an ocean of opportunity. I can't go anywhere without thinking, shit, that's going to be a really good business opportunity. And then I have to go, oh, no, too many spinning plates time, calm down. And so that's the types of questions. And also you can use that with tragedies. You can go, right, or if something really bad happens, you go, okay, what needs to happen so this shit never touches me again, ever? And that way you can mitigate risk. And so that's the types of questions. And then you need to think the quality of questions. So you need to think, well, okay, instead of thinking what needs to happen for me to buy this widget, you need to say, well, just think bigger. So go, okay, what needs to happen so I own this shop, so I can have every widget? Or what needs to happen for me to buy this house? Or no, what needs to happen so I can buy the village? Just think bigger. And eventually, over, a few months of ramming this stuff into your head, this whole Tony Robbins type stuff, your brain will just change. So, yeah, some person after the TED Talk said, you can't do this, it just can't be done. And my brain just sort of exploded inside. I was like, why not, why not, why not? And they just couldn't give me an answer every time I said, why not? And I was like, it's just not done that way. Well, why not? And I've got a filter. Sorry if I'm rambling, but I've last thing. I've got a filter in my head. So whenever I have a decision to make, and I'm not sure. I run it by this filter, and it's basically, am I going to die or is someone else going to die? No. Okay. Am I going to get hurt or is someone else going to get hurt? No. Am I going to jail or is someone else going to jail, or am I breaking the law? No. Well, they're the three worst things that can ever happen. So if it doesn't meet those three criteria, well, then just freaking do it. So what if you fail? So yeah, that is literally the worst case scenario.
Yeah. Man, what a brilliant answer. I'm loving this. There's one more thing I want to ask you, and then we should probably wrap this up. Now, when we started talking about the schooling aspect, you were saying that as we keep moving in the future, there's going to be a point where more and more jobs are being taken over by technology and robots. How are humans going to stay relevant? Because like not everyone wants to be behind this technology and behind these robots creating things. Like some people are happy just working in the factories like we talked about earlier. Where are humans going to go? Like, what's going to happen when robots become more prevalent?
Yeah, so it's a really good question. And the thing is, people have been saying the same question for centuries now. So if you go back just 100 years, like depending on what country, like if you take the UK, 90% of people worked on the land. That's nuts, isn't it? Like 90% of the people were farmers of some sort. And then obviously we got tech like tractors and, better tech. And now we have less than like 5% of the population are farmers. Where the hell have all those people gone? And at the end of the day, humans are resilient creatures, and we always adapt. And basically, we always upskill. So the farmers had to upskill and do something else. And it's exactly the same this way. However, I do think this is a huge topic which we do need to look at, because the rate of change this time round is going to be far quicker than anything humans have ever seen in history. Like if you look at the transitions of the energy transitions, it's long. So for thousands of years, we went from, we used wood as energy, and then we went to coal. And the transition from wood to coal was like 200 odd years. And then we went from coal to oil, and that transition was like 100, 150 years, depending where you are on the planet. And like, we're still using oil. Now, obviously we don't have a new form of energy. Ultimately, I think solar is the way forward. But like the rate of change is increasing massively because tech is on an exponential growth. And for those, I don't want to teach people get people to suck eggs. I mean, if you're not really familiar with exponential growth, please study the hell out of it. It's scary, especially when you're looking at global debt and global currency expansion. But and yeah, so the next transition, robots are going to absolutely take over the world in terms of jobs before we even know it. And so that is going to be a massive shock. And so, yeah, there will be huge unemployment, in some sectors. I mean, China is leading the way. I mean, I read a fact, there's this region of factories, 160,000 people have just lost their jobs. Just because the factories have just got rid of the people and they've put robots in instead. Now, a lot of the news in China is being smothered because it's a nanny state, so to speak. But it will happen, and I think ultimately at the end of the day, we'll all have like a universal basic salary, just like like Switzerland just declined. We'll all end up being paid by the government like $1,000 or £1,000 a month just to live, and that way we can then start working on better stuff. That's what I personally think. But yeah, I think at the end of the day, those that, like the taxi driver, like if you go, this is the prime example. Taxi drivers in London, so black cab drivers are the best example. I go to London a lot, and I always get a black cab because I just love chatting to the cabbies and just getting a view of their mindset. And no offense to them, they're so stubborn and so backwards. Like anyone can see that Uber is absolutely destroying the taxi world, especially in London. And like all these taxi drivers are just bitching and whining about Uber, when in fact they should like be, really being concerned. I mean, hell, they should, if they're really concerned, they should, at least, go long on Uber. So whatever they lose in, fares, they can mitigate on, Uber or whatever. But they need to start reskilling now. They need to, adapt now before, automated Tesla cars take over the whole taxi world, basically. So yeah, I ultimately, I think the next 5 years, we're in for an economic shitstorm like we've never seen before. I really do believe we're going to have an economic crash at least 10 times bigger than 2008. So this equity crash will spill over and start another property crash. We're going to have a bond market collapse as well. However, and we're going to have all this, upheaval. But I think 10 years plus, the world is going to be some awesome, it's just freaking awesome. Honestly, there's a book created by Peter Diamandis called Abundance. The future is brighter than you think. And I encourage every single person that's listening to this to get that book. It's a thick one, but just read it. Honestly, the future is so positive. It's silly, but just over the next 5 or 10 years, you just got to weather the storm.
Great stuff, man. I'm gonna check that out. I interviewed Michael Siding. I'm sure that's how you pronounce his last name. He's a or former fund manager in Sweden, and he was on the podcast a little while back, and he spoke a lot about AI and robotics becoming more prevalent in that. It was it was very interesting. I find this whole subject fascinating anyway, but I'm sure we could go down a whole nother rabbit hole again, but let's cut it off here. So I just want to say, Simon, thank you so much for doing this, man, and I appreciate you taking the time. It's almost 2 hours now to speak with me and share, a lot of really great insight with everyone who listens to this podcast. So yeah, thank you very much.
No, thank you for your time. I'm sorry if I've rambled on for a bit. Yeah.
Not at all. That's the whole purpose of doing the podcast. We don't have any time constrictions, so it's good in that sense. Where's the best place listeners can go to find out more about you?
I don't want to plug anything, so I would just say YouTube my name, Siam Kid, on YouTube. I try and put 1 or 2 new videos up on there. And if people want to, do more digging around on me, I mean, there are links on, my videos and whatnot. But I think that's probably the best thing.
Okay. And do you want to share your Twitter handle?
Yes, Siam Kid. So it's SIAMKIDD. And I'm loving your program. Honestly, Chat with Traders you're doing more for the trading community than any other thing I've come across. Like the knowledge you're putting out there for free is just remarkable. So I have to thank you because I love listening to them. So.
That's huge. It's awesome to hear that coming from you. So thanks very much.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders collaboration with Quantopian, episode 3. What's good, traders? Welcome back for part 3 of 6 in the series, which is a collaboration with Quantopian. If we've not met in the past, my name is Aaron Fifield. I'm your host, and thank you so much for being here. So following on from the previous episode when we spoke about alpha factors, this episode is a continuation as we discuss what comes next in the workflow of many quantitative trading firms, and that is combining alpha factors. So we discuss why this is something which you would want to do, some of the various techniques quants use for aggregating alpha factors, and other topics that surround this subject too. So for this episode, Delaney and myself are joined by Jonathan Larkin, who is the Chief Investment Officer at Quantopian. Jonathan's been trading in the professional space since the late 90s, many of those years spent at JP Morgan. Now, just to remind you of a few things, if there are any questions you have, please go to quantopian.com/questions. That's where you can submit questions and ask anything you're unsure about relative to the topics and the theme of this series, of course. Episode 6 is the Q&A episode, and that's where we'll answer as many of these questions as possible. Any links and additional resources which get mentioned during this episode or any other episode in the series have been curated for you at quantopian.com/chatwithtraders. So that's well worth a look. And you can also find the same on the Chat with Traders website also. Now, I've mentioned this previously. This series is sponsored by datacamp.com. So for those of you who want to learn how to code, specifically in Python or R, I definitely encourage you to visit datacamp.com. They have a whole array of online courses that specifically teach data science, data manipulation, data visualization, probability and statistics, and machine learning, all of which is relevant to quant finance, and their courses vary in difficulty from beginner to intermediate. So to start any one of their online courses now for free, simply visit datacamp.com and create an account. And if you like, this would be really cool actually. So if you like, tweet me at Chat with Traders and let me know which course you decide to start with. I think that'd be really cool to hear about. So at Chat with Traders, tweet me which DataCamp course you plan on starting. Again, that's datacamp.com. Now, one last thing, just quickly, there is a small amount of background noise in some parts of this episode. So I do apologize for this, but please just push on. It's really nothing too major. Well, that's all from me. Let's bring in Delaney and Jonathan Larkin. So Delaney, how you going? Good to be speaking again.
Yeah, I'm doing pretty well. I mean, again, I say this every time, but constantly in just a state of being massively busy, but just a lot of really interesting stuff that's coming along. So, you know, I can't complain. Absolutely.
Nice. Well, it's a good state to be. And for this episode, episode 3, in this 6-part mini-series, we've got Jonathan Larkin joining us. Welcome, John. How are you?
Hi, I'm good, thanks. Good to be here.
Excellent. John, I think it would be really cool if we could hear a bit about your background just before we get stuck into the subjects we're going to be discussing today. But yeah, I mean, tell us a little bit about how did you get your start in the world of quant trading and investing? I think that'd be great to hear.
Sure, absolutely. About 20 years ago, out of undergrad, I joined investment bank JP Morgan in their training program. Spent about 10 years there in equity derivatives. And equity derivatives, is a quantitative discipline, great learning ground for learning the markets. Can be as technical and as quantitative as you want it to be, but at the end of the day, you're also trading underlying stocks, so you get a bit of the fundamental angle as well.
Okay. And I know you've worked at a number of firms since then. Can you tell us about some of the various roles you've had over the years? I know you were at Millennium Partners for quite a few of those.
Sure, absolutely. First half of my career I spent on the sell side, and the second half has been on the buy side. So I've been in the hedge fund business now for a little over 10 years as well. My experience has been working in multi-strat hedge funds, and within the multi-strat space, the multi-manager hedge fund segment as well. So firms that hire very many individual portfolio managers and aggregate the risk of individual strategies into one commingled vehicle.
Excellent. Well, that's really cool to hear. And of course, you're at Quantopian now. What is it you do there exactly?
Sure. I'm the Chief Investment Officer at Quantopian. So I'm the one responsible for putting together the investment vehicles that we're ultimately going to offer out to clients in the near future. So aggregating the strategies that we license from our community of authors and assembling those together into a single investment vehicle.
Very good, man. Well, this episode we're going to be discussing classifiers and in some ways I think continuing the discussion about factors as well. So I think probably the best place to start is by me asking, what is a classifier and how would you explain this?
I can take this one because I'm going to leave the complicated stuff for Jonathan. But
you get the softball question.
I get the softball ones. So a classifier is a very common notion in statistics, and it's actually one of kind of the key components in a lot of modern machine learning. So the notion of a classifier is quite simple at its base level, which is really just a function that takes in an input and, classifies it. So produces an output of some category. And the simplest example might be a binary classifier, which takes in some input and then classifies that input as an instance of a one set or another set. It's only two options. It's a binary classifier. So in a sense, when you think about making predictions on stocks, you can think of that as being a classification problem, because at every point in time, you're trying to decide whether the stock is a member of the set of stocks that's going to go up in the future, or whether it's a member of the set of stocks that's going to go down in the future. And it turns out that once you start thinking about any predictive model as a classifier that's basically trying to pick, longs or shorts, it makes it a little easier in other ways to think about, your entire workflow, your entire infrastructure. So, at its core, I'll just give you a real example of a classifier. A classifier exists within a fire detector, a smoke alarm, right? And every time point, that smoke alarm looks at the input data that it's getting from its sensor, and it says, I want to classify this as an example of there being a fire or an example of there being no fire. And it just does that repeatedly. And so, a good classifier is going to say no fire when there's no fire and fire when there's fire. But of course, it's imperfect. And that's why sometimes you get it ringing when you're just making breakfast. Okay,
so forgive me if you've already kind of explained this in that answer, but why would you want to use a classifier, and how does that actually look? Like, where does a classifier fit into your algorithm, into your whole sort of trading strategy?
Basically, any model that forecasts stocks as going one direction or another can be thought of as a classifier, because you are classifying stocks as going one direction or the other direction in the future, namely up or down. So again, it's just a way of thinking about your model, and it's a way of simplifying it a little bit. And it falls into this notion of kind of accepting that you're not going to be super accurate, because when you have a model that predicts future returns, it's really hard to predict the exact future returns, right? That's something that in general, and Jonathan is having much more experience in the industry than me, may have a different opinion on this, but in my opinion, generally, it's very difficult to predict, absolute amount of future returns. And so sometimes what people will do is they'll simplify the problem into saying, rather than predicting absolute amount, let's just predict it's going to go up or going to go down. And sometimes you can kind of formulate that as an easier problem because you're making a softer claim.
Right. There are two trends that have really caused this concept of a factor as a classifier to emerge. The first is that, historically, when I say historically, I'm talking maybe 5-10 years ago, you could build a quant strategy around a single alpha factor, or maybe 2 or 3 alpha factors. But the world is quite competitive, and this is a quite lucrative endeavor. So over time, a lot of the ability to generate a strategy out of a very few number of alpha factors, that's gone away. It's been competed away. So today, strategists and portfolio managers are faced with the task of combining many alpha factors into a single prediction or into a single portfolio. And along this time, there's been quite a number of scientific advances in machine learning, and as it relates to this, specifically something called ensemble learning, which is the process by which multiple single classifiers can be combined in an intelligent way to produce a result which is vastly superior than any one single classifier.
Yeah, and I think that's something we're really going to get into during this episode, is actually combining multiple alpha factors. Just before we do, though, last episode we did speak about alpha factors in general. What relationship do alpha factors have with classifiers? Like, how do these kind of fit together? Like, how does one lead into the other?
So an alpha factor, the output of an alpha factor is some kind of ranking or some kind of relative value across your universe of securities. So if you have 1,000 securities, your alpha factor will be a number per security that is proportional to your model's expected return per security. So you have one value per security. The value could be a rank. It could be any sort of dimensionless number that comes out of your calculation, as long as the ordering that those numbers produce is proportional to the expected forward return across the universe. And when you have a classifier, you're talking about a much reduced output set. So Delaney was talking about a binary classifier. You could classify stocks as ones or negative ones, and the ones will be stocks that are expected to significantly outperform, and the negative ones could be stocks that you would expect to significantly underperform.
Yeah, and as a follow-up to that, let's say that you have an alpha factor and you've ranked all your stocks based on their expected return, their relative value. And then you go long the ones on the top equal weighted, and you go short the ones on the bottom equal weighted. Again, just like kind of that simple continuation of the strategy that we talked about last time. Sometimes referred to as like long short equity or factor-based long short equity. So if you've done that, well, in that case, really that's no different from taking your alpha signal, your score for each stock, and then just converting it to a 1 or a negative 1, depending on its, whether or not it's above or below your cutoff. Maybe that's the mean, maybe that's a 10% cutoff on either side. But really, it's the same as if you had said, take my alpha score and then convert it to a classifier by saying, if it's above half, convert it to 1. If it's below half, convert it to negative 1, and then go long on all the ones, go short on all the negative ones. So that's another way of thinking about the connection between an alpha factor and a classifier based on how you would actually trade off of it.
Okay, sure. So, as Jonathan kind of hinted before, you want to combine alpha factors. And I know this is something you wanted to speak about, Delaney. So, you wanted to talk about the subject of how a single alpha factor is a weak classifier. So I think it'd be great to hear your thoughts around this.
Yeah, well, I mean, I'll just kind of briefly give my thoughts, and then I think it'd also be great to have Jonathan speak on this as well. But in general, in statistics, there's this notion of combining weak predictive models. And what that means is, let's say that you have some model and it's okay. It's not great. It gets the answer right more than half the time, but, not 95% of the time. Well, you can think of that as having a model with some signal and some noise, right? And, the idea is that, it's going to have some true signal plus or minus some noise. And the noise can cause the answer to be off in either direction. And if you have two models, and they're both not super great, but then you put them together, the idea is that the signals can add up, but the noise, because it's kind of random and goes both directions, will hopefully start to cancel itself out. And so oftentimes, by combining multiple models that all have some predictive power, you can kind of reduce the noise around your signal while actually keeping the same signal or even increasing the signal. And another way to think about this is just having multiple lenses, multiple angles onto some problem. You're combining many different perspectives into one much better overall picture. And it's no different with classifiers. So with classifiers, if you have multiple classifiers, all of which aren't super great on their own, just like Jonathan was saying earlier, there's a whole branch of statistics and machine learning which deals with combining these things such that the end result is this new kind of monster classifier, which is just much better than any of them on their own. And in fact, oftentimes you can get it to be better than all of them kind of combined by this effect of the noise reducing. So if you have a bunch of alpha factors, which are kind of not super great on their own, oftentimes there may be opportunities to combine them in intelligent ways, which reduces the noise without sacrificing too much of your signal.
Is there anything you want to add on to that, Jonathan?
Well, it's hard to improve on Delaney's outstanding explanation. But one thing I'll say is the concept of weak in the term weak classifier, is very important. A lot of single alpha factors, have decayed over time, and many market participants, think that weak factors are no longer useful or no longer profitable, in trading strategies. But part of the magic of ensemble learning is that as long as you have a weak classifier that's marginally better than 50% success rates, that can be additive to a combined model.
Now, when you say if over 50% success rate, how is that success rate measured?
It's quite simple. The model makes a prediction, +1, -1, +1 for stocks that are outperforming, -1 for stocks that are underperforming. And it's simply the hit rate of those predictions.
But for that prediction to be deemed accurate or inaccurate, doesn't there need to be some sort of time factor involved for like the time span for how far ahead it's predicting, which is something that hasn't really come into the picture yet?
So that would be defined, as you model out your single alpha factors. So the single alpha factor, when I was talking before, you have some relative ranking across your universe, and that relative ranking is proportional to forward returns. Of course, you have to define some kind of period, over which you're looking to forward returns, and you would want to be consistent across all of the alpha factors that you're combining.
Okay, I think that makes sense. So how do you actually go about aggregating multiple alpha factors together? I think that would be interesting to speak about.
So, there's a few different ways that you can start approaching this. But actually, something I actually want to touch on briefly, maybe even before we go into that, is just some of the reasons why, individual factors may not be very good on their own. I just had a few notes here of kind of just high level reasons why that might be the case. One of them would be factor lifespan. Like Jonathan mentioned, when a factor becomes well known, it loses its edge because everybody knows about it, and there's no longer this kind of novel signal that you're trading off of. Everybody else has already gotten ahead of it. It's all arbitraged away. Other reasons that a factor might not be very good on its own. It's possible that you've discovered an alpha factor which has a signal over random. So it has quite a good accuracy rate, but when you actually do, say, a back test and look at the transaction cost you'd be paying on trying to trade that factor, you find out that to get to hold a portfolio based on this factor, you'd have to be trading so many stocks that you'd be paying a ton of transaction costs. And so that factor by itself, whereas it may not be tradable, it may be producing a signal that when combined with some other factors would produce a tradable portfolio. And in similar ways, issues with not being able to trade a single factor based on liquidity, not being able to trade a single factor based on market impact, or just not being able to trade a single factor because it's not super accurate by itself, are all things in which, by starting with a factor that by itself is not very good, you could actually add it to a bunch of other factors and come up with a model that is quite good together. So sometimes, something may look like garbage on its own, but there may be a use for it, especially if it's uncorrelated with other known factors. So just to start talking about combining them together, the simplest approach would just be averaging them together and not doing anything else. I think that there's not a not insignificant fraction of people who just will average factors together. Then you can start getting more sophisticated. Let's say that you have a dynamic weighting system in which you weight the factors based on some historical metric. The historical metric could be maybe like the trailing 3-month accuracy of the factors when treated as a classifier. And then you can even go beyond that when talking about some of kind of the newest and most exciting ways to combine factors, which fall into this category of machine learning. And like Jonathan said, ensemble learning, which would actually be using what's known as a signal boosting algorithm, a signal boosting machine learning method, which takes multiple factors and attempts to use machine learning to produce at every time point good combinations of factors that will produce very strong predictions going forward.
The concept of combining factors is, as old as quantitative finance, itself. You certainly don't need machine learning to do this, and for 30 years, people have done it without machine learning. As Delaney mentioned, simple averaging is fine. Simple regression type techniques, where you're predicting the composite return, across many factors, is one technique. It's really been, in the last 5 years or so where machine learning has come to the forefront, and it really, really does outperform a lot of the simpler or more historical techniques.
Okay, now in your response there, Delaney, you brought up an interesting point right at the beginning about the lifespan of your factors. I mean, how do you think about the lifespan of your factors? How do you monitor that sort of thing?
Well, so people like to talk a lot about alpha, right? And alpha is often one of the metrics used to describe the quality of a factor. And in this case, alpha refers to what you have in the factor that's left over when you explain away all the parts that can be explained by known commonly used factors and techniques. So what do I mean by that? Well, let's say that you were to take the return stream of a portfolio that was based on trading some factor A, and then you said, okay, well, I know that factors B, C, and D are just super well known, in the market. Everybody knows about them, and I want to see how much of the return stream from my new factor A is coming from B, C, and D. B, C, and D could also be factors that you were already trading in your model, and therefore you want to make sure that your new factor isn't just a recombination of the factors that are already trading in your model. You could run a regression using A as the outcome or dependent variable, and B, C, and D as the independent input variables. And if the input variables explain A well, then basically you'll have high coefficients. You won't have much alpha. Alpha, of course, in the regression model represents the constant amount of returns that are just not explained by your other input variables. And so what people will do is they'll construct alpha models in which they try to look at how much alpha is coming out of a factor that's unexplained by other known factors. And that's one way you could start measuring over time how well a factor is doing, and then also start looking for the decay of the factor. As maybe over time, other people started to learn about the anomaly, other people started to trade it, it starts being eaten away. And oftentimes I think what you'll see is if you put in factors that maybe used to be traded, used to work, you'll see periods of higher alpha and then a gradual decay as people discovered it and started trading on it. So that's in my understanding one of the common ways you would do that. Obviously, the choice of what input variables you'd put into the regression model, that's not trivial. But that's one of the ways you kind of analyze the lifespan of a factor as it started out having a high alpha, high explanatory power, and then kind of maybe started to trail off over time. You could also potentially measure the accuracy, like Jonathan was saying, just how often of the time it gets right that a stock is going to go up versus a stock is going to go down. Jonathan, are there other things that I'm missing here?
I think that's a great explanation, Delaney.
Okay, now when you talk about regression models, I think it might be helpful if you could just explain maybe what are regression models. Like, what are you referring to there?
Sure. So, and we'll have links to this stuff up at quantopian.com/chatwithtraders. Again, that's going to be our universal link that we'll try to put all of the content on. We also, in the Quantopian lecture series, that's quantopian.com/lectures, we show examples of regression models being used for precisely this purpose in the lecture series. We actually have like primers on regression and multiple regression models, and then primers on factor models, which use a lot of regressions. And the notion is that a regression model just attempts to explain the results, in one variable with some other variables. So for example, if you thought that there was a linear dependence between the amount of trades that you made and the amount of money that you made, what you could do is you could put the amount of trades that you are making in as an input variable, the amount of money that you're making as an output variable, and regression would tell you kind of on average, assuming there's a linear relationship, what multiple of money you're making what multiple of trades you're making is the amount of money you're making. So if for every trade you make, you get $2, a regression would say, oh, well, I'm going to give you that the money you're making is 2 times the trades you're making. So it's just a way of estimating dependence. And there's many like little tricks and gotchas and assumptions that have to be satisfied. And we discuss that in the lectures. But again, the notion here is really that what we're trying to do is we're just trying to say, great, you discovered this really interesting new way of ranking stocks. Now, how much of it is just coming from stuff that's already known about? Because if you run a regression model and you discover that your factor is very well explained as 0.5 times this known factor plus 0.5 times this other known factor plus 1 times this third known factor, then you're not doing anything new, right? There's no alpha there. The alpha is going to be 0 because there's nothing left over on the table after you've explained it out by these other factors. And so we're trying to measure the dependency using a regression model. Beyond that, it's hard to explain without visuals in front of you. So I recommend that people who are interested do check out the lecture series at quantopian.com/lectures. There are a few different ones on linear regression models.
Absolutely. Now, just continuing on the point of aggregating multiple alpha factors, let's say you have an alpha factor which is really good. It's a good alpha factor. Is that something you would still want to combine with weaker alpha factors?
Just from first principles and, just discarding any kind of advanced, sophisticated machine learning, if you have factors, which have 0 correlation to each other, in an ideal world. So, forgetting about the implementation cost of, potentially trading some of the weaker factors. If you have factors that have 0 correlation to each other, you would always want to, combine those. You will always get an incremental benefit, in risk and return. Now, in some cases, taking into account, real world barriers such as frictions and trading costs, without machine learning, a very simple combination, may not give you any benefit. But when you use a modern machine learning technique, as long as your weak alpha factor is somewhat predictable, even marginally positive predictable, it will benefit you in the output, the combined model.
Now, the term machine learning keeps coming up throughout this conversation. I know we're going to get into machine learning more in episode 5, but as it's come up a number of times, I think it might be helpful if we could just have like a quick overview of how machine learning actually aids in aggregating multiple alpha factors.
So the machine learning techniques that we're talking about here are classification techniques. And what these techniques are very, very good at is, finding, very, very complex and hidden structures within data. Traditional statistical techniques, are good at finding linear relationships, between different variables. But the real benefit of machine learning is that you can uncover these nonlinear relationships. And by that I mean, it's very, very difficult, without these techniques to understand, how different factors interrelate, and when one is predictive and the second one is not, is predicting in the other direction, and the third one is predicting in the other direction, that might be, one result. If they're all predicting, in the same direction, that might be a different result. And, the different result states can be non-obvious, and machine learning is very, very good at uncovering that hidden structure.
Right. And just to be clear, you're talking about machine learning in regard to actually aggregating multiple alpha factors, right? You're not actually talking about machine learning as a means to discover alpha factors in themselves, are you?
That's an excellent distinction, and is absolutely spot on. I'm not saying it's not valuable machine learning. I'm not saying machine learning is invalid to generate a single alpha factor in itself, but where I've seen the most success in practice is in the combination step.
Okay, yeah, good answer. A little earlier you mentioned correlation. So, what considerations need to be made when thinking about the correlation between multiple factors?
So correlation is a measure of how one variable explains another variable. So in our sense, we would want low correlation. We would want the results of one factor to be unrelated from the predictions of another factor. And the thing that I look for in individual strategies is I look for a high Sharpe ratio. So the Sharpe ratio is the ratio of the return of a strategy to the volatility of a strategy. And it happens that when you have strategies that have low correlation with each other, or factors that have low correlation with each other, and you combine these, the returns combine in a linear way, and the volatilities combine in a sublinear way. They combine actually, in relation to the square root of the number of factors. So that is kind of portfolio effect magic. And when you add up factors that have low correlation, you get the magical effect, that you get significantly enhanced risk return on the combination.
Yeah, and just to add to that, you can kind of think of this at a meta level as, each factor is really just an asset you can hold in your portfolio. And I've referred back to this lecture a few times, but if you go to the Quantopian lecture series and you go to the position concentration risk lecture, it really tries to drive home this notion of why you shouldn't invest in few assets, and also how investing in multiple uncorrelated assets can do precisely what Jonathan was describing, with bringing down the variance and the risk while not sacrificing on returns. And so the same thing is true for alpha factors. If you consider each alpha factor as kind of the returns that you would get trading on just that alpha factor, well, averaging them together, will kind of be the same as averaging together the return streams where you're just trading on that alpha factor, and can produce a return stream in which you're not sacrificing on the returns, but you are bringing down the variance. Another point that I wanted to say, which is related to that, is in terms of thinking about this correlation from a more intuitive level for people who may not have had, as much mathematical background. One example that you can use to think about this is, say, you're polling people and you're trying to figure out how an election is going to go. Well, if you poll someone and then you poll their neighbors, maybe their neighbors have a very similar perspective on the world as that person. They have the same outlook. Their views, their beliefs are likely to be similar, and whatever they tell you is likely to be kind of correlated. There's not going to be a huge amount of difference. But then as you go and, poll someone in the next neighborhood and poll someone in the next state and poll someone in the next country, you're getting an increasing variety of different perspectives on the same issue. And basically you can think of this in the same way with factors, that if two factors are very correlated with each other, if they kind of live in the same world, they're not going to explain anything new. So that's another kind of intuitive reason why you want to try to get factors which are very new and different from each other when you're building up a model which combines factors. Because if you're just combining factors that are similar to each other, you're not getting anything new, and the resulting combined model won't really be any better than the individual correlated factors.
Yeah, that's a really great analogy there, Delaney. I like how you did that. When we talk about combining multiple alpha factors, how many alpha factors are we talking about? Like, what's a good number? Are we talking about, like, sort of combining 5 or 50?
So this is just a kind of a practical, answer just based on my, experience. The shorter answer is, the more the better. The longer answer is, in equity strategies, you tend to start to get diminishing return from combination, after you, you reach, about 25 factors.
Okay, interesting. Now, Jonathan, you said just before that you like to focus on, I think it was strategies that have a high Sharpe ratio. Would you mind explaining your reasoning for this?
So the Sharpe ratio, to me, is a measure of the quality of the alpha of the strategy. So, ultimately, we want to produce a vehicle for investors, which they find compelling, which they think is very, very competitive, versus competing funds. And Sharpe ratio is a industry standard measure, to measure the quality of returns. So we're not interested just in producing a high return over the course of the year. We're interested in producing consistency of return as well. So we care not just about the absolute measure of return, but we care about the volatility of those returns and the path that those returns take.
Okay, good answer. Now, Delaney, I think you wanted to bring up XAUUSD algorithms. Was there anything you wanted to talk about in regard to that subject?
So basically, XAUUSD is a machine learning algorithm, and it specifically is one of these ensemble algorithms that tries to take multiple classifiers, which aren't very good on their own, have maybe a signal that's barely better than flipping a coin, and combine them together to produce something that's much better than the sum of the parts. And there's actually some implementations that are currently being worked on by Thomas Wiecki, who's Quantopian's chief data scientist, and he has posted some examples of this in the forums on Quantopian, and we'll link to them again. If you go to that quantopian.com/chat with traders, we'll have a collection of like all the appropriate links for that we talk about in each episode. But the notion is really, and again, I'll try to explain it with an analogy here, and then I'll maybe let Jonathan jump in with some more kind of specific comments. But the analogy that I like to use with these algorithms is really kind of this notion, and it can be a little hard to wrap your head around at first, but it's really common, especially in computer science, that if you have a process which gets the answer right, say 51% of the times, 51% of the time, well, rather than running it once and then, just believing it based on that one try, which, is going to be pretty inaccurate because it only gets it right 51% of the time. There's this notion in computer science of kind of signal amplification, in which you run it thousands or tens of thousands of times, and you look for the answer that it picks the most. And usually, if you're choosing, let's say, between two outcomes, well, if it's going to choose the right outcome 51% of the time, if you run it lots and lots of times, you'll notice that it's very likely that it will produce more correct answers than it will produce incorrect answers. And so you can pick the thing that it picks more of the time. Now, sometimes that can be hard to do because maybe you can't get 10,000 independent runs. You can't run this thing 10,000 times. What a boosting algorithm like AdaBoost tries to do is saying, like, okay, we have a set of, let's just say like experts, and they're all making predictions, or classifiers, and they're all making predictions. And I don't fully trust the predictions that any one of these guys are making. But can I combine them in an intelligent way and kind of average together their predictions into a meta prediction, an overall prediction, but that doesn't trust any individual expert, but tries to get at what signal is existing across this entire set of experts.
Yeah, I think to add, the way that type of algorithm works is, you just to start with kind of assuming they're all equally valid, and then that assumption will produce predictions in your training set, and you compare those predictions to your training set. And then, you start to iterate and you start to modify how you're weighting these individual experts. As Delaney was saying, I thought that was a good term. So weighting these individual experts, and then you iterate through different weighting schemes, until you reach a certain threshold of improvement.
Yeah, I think definitely for more information around that, it'd be a good idea to check out the link Delaney shared with you just before. All these things which we've discussed up to this point, are these things which can be done on the Quantopian platform, or is there something more required?
So everything we've been discussing, can indeed be done on the Quantopian platform. So the educational materials and the links that Delaney had mentioned, those will show a walkthrough from first principles, using completely the Quantopian platform.
Right. And as we do this podcast and we're stepping through these various components of the workflow of a professional quant, for someone to actually apply this and implement these things, is that something independent traders and independent quants can realistically do, with a bit of time, with a bit of study and, some effort? Or is this sort of a bit more advanced than that?
I don't think there's any barrier to entry, with understanding the techniques. However, the quant workflow, that we're describing, and certainly the factor type analysis and the creation of alpha factors, those are factors that predict returns across, very many stocks. So, you don't need a particularly high hit ratio, 55%, 60% hit ratio. You can get an exceptional portfolio return if you diversify that, across, very many stocks. And, that is something that creates a barrier to entry, for independent traders. You need to have, quite a bit of capital in order to be able to trade a portfolio of, 1,000 stocks.
Absolutely. And is there anything you'd like to add on to that, Delaney?
No, I mean, I think that's all exactly right. Obviously, like the restrictions of how much capital is available is an important thing to consider. And then like the other thing is really with these factors, I mean, you can certainly pare down the universe and make it so that you're selecting 10 factors to go long on and 10 stocks to go long on and 10 stocks to go short on from that ranking. But again, because you're investing in so many fewer assets, generally you have to have a much higher confidence in, a much higher accuracy for your model. So the same factors that work for predicting future returns across these very broad swaths of assets may not be appropriate for people who are trying to trade portfolios of 10 or 50 assets, because when you're trading that many fewer assets, you need a higher, accuracy on your model. Otherwise, you face more risk. So, you might have to develop different models or maybe just not even use the same workflow. The thing that's nice about this workflow is it's just a really nice and general way of thinking about investing and thinking about, in general, a model just classifies things as going up or going down in the future. And you can't really get too much simpler than that. So, and the other thing to remember is, if you discover a factor, even if you can't necessarily trade it, if it's a good factor, it has value. And just because you can't trade it yourself doesn't mean that it's not worth anything to you.
Yeah, that's a really good point, actually. Is there anything else either of you would like to add before we wrap this episode up?
I'll just say, this stuff can be pretty difficult to understand on first pass. So like I said, I think last time we put a lot of effort into the lecture series here at Quantopian. We're not going to have, full coverage of everything we talked about quite yet. We're going to have coverage of most of what we talked about. But again, the two links that are important, and I recommend if at any point something piqued your interest or you didn't quite follow, just go to quantopian.com/lectures for all the lectures. And then we'll also try to link to specific resources, and then also that implementation of AdaBoost that Thomas made. If you go to quantopian.com/chatwithtraders, we'll have specific resources there for you. Jonathan, did you have anything else?
I just wanted to add that, this is not a theoretical discussion at all. These techniques, are being used very, very successfully, at some very, very large and famous hedge funds. So, we're excited to bring, this educational material, to our community, and we're excited to see what people will do with it.
For sure. Good points. Now, we've got episode 4 coming up next. Delaney, do you want to give us a quick summary of what our listeners can expect to hear from that one?
Absolutely. So again, with the theme of these episodes is just when you think you figured it out, we're going to go a little deeper and show you how we need to actually do more. So with episode 4, let's say that you've got a great combined, alpha model, and it uses 10 factors and it does some really great weighting between them and everything's looking awesome. That by itself, if you just went to trade and you went longs and went short based on the predictions of that model, you could still run into situations in which your portfolio could get into very bad states in regards to the risk that you're taking on. Factors might have biases towards certain sectors. They might have biases towards taking on more longs than shorts. Lots of different things can go wrong. So what we're going to talk about next episode is this notion of portfolio optimization, and how to actually go from these desired factor positions, things that the model wants you to take, the positions the model wants you to take, to actually something that you would be comfortable trading in real life. And for that discussion, we're going to bring in Scott Sanderson, who's a really, really smart engineer here, works at Quantopian, and is currently designing an API that's going to do precisely that. So he's like a really good person to talk to about this. His background is actually math and philosophy. So it's always a great discussion with Scott.
Cool. Yeah, no, I very much look forward to that. Well, Jonathan, I just want to say a special thank you for coming on to this podcast. I appreciate you, coming on and sharing your insight from, 20 plus years in the industry. So that was great to have you, man. Thank you very much.
Yeah, absolutely. I enjoyed it. Thank you. Thanks for your interest and for your support, ongoing support of this series.
No trouble at all. All right, Delaney, let's leave it at that for now, and we'll call this a wrap. Links in the show notes as per usual. Eugene, thanks very much for doing the podcast, man.
Updated with hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders. Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, boys and girls? Welcome back. On this episode, I am joined by a quant trader who works at a high-frequency trading firm, though you might be surprised to hear he started out on the exact same path that many retail traders do. His name is Dave Bergstrom. Dave is someone who I've followed on Twitter for quite some time. He always has interesting things to share, and I've had the pleasure of speaking with him numerous times also. Now, the thing that I think makes Dave quite unique from most traders who have been on this podcast previously is how he uses data mining techniques during strategy development. Data mining in the realm of trading often has a negative connotation attached to it, but Dave believes this comes from bad practices and poor evaluation of methods. So in addition to data mining and ways to reduce curve fitting, we also talk about escaping randomness, learning to write code, Dave's 3 laws for strategy development, setting expectation, and a few other things too. And lastly, there are 2 links I'd like to share with you. So the first one being buildalpha.com. Dave has recently developed a software package which has the functionality to perform many of the techniques and different forms of analysis that we discuss on this episode. So if you're really into this sort of thing, you can take a look at that at buildalpha.com. And second of all, Dave has kindly offered to answer any trading questions that you may have. So if you'd like to take advantage of this, simply go to chatwithtraders.com/103, scroll to the bottom of the page and leave your questions in the comments area. All right, team, that is it. Without any further delay, please welcome Dave Bergstrom. So, let's start right at the very beginning. What was your introduction to trading? How did you start out?
Oh, geez. So actually back in undergrad, I was on track to go to law school, and about halfway through realized that I wanted nothing to do with law school. So I kind of searched around for, other things that, maybe I could pick up and change careers with, halfway to go in school. And, the market on the side seemed like a pretty good idea. And I had a little bit of a nudge from my father, who worked at Del Monte Foods and was kind of involved with their, corn hedging and all, and all that for their ingredients. But yeah, so just kind of, just see about it, hear about it, think it's an easy way to maybe get rich.
Yeah, so that must have been a pretty big decision for you to drop out of law school and pursue something like trading.
Well, yeah, I mean, just to clarify, I never actually made it to law school. I don't want to discredit any lawyers or law school people, but that was the career path. But yeah, the dropout, I mean, I did have some early success trading that kind of made that decision a little easier. But knowing what I know now, I'm not sure that should influence the decision at all.
Okay, so how were you trading in the very beginning? Like, what were your decisions to buy and sell based upon?
Yes, when I first started, I think I took a pretty common route now. You know, I kind of just searched for information on the internet and found like finance Twitter and all these chat rooms and, podcasts, which I wish yours would have been around back then. Would have saved me some time. But, I was trading basically, chart patterns, momentum stocks, a lot of the popular chat rooms, I kind of been, watching them grow because they kind of all started evolving when I kind of got into trading, which was like, right around and after the financial crisis. So, my beginning trading is much different than how I trade now.
Okay. So, I mean, how did you get into trading? Like, were you working a job at the time? Were you still going to school? Obviously you didn't just make the jump into full-time trading. Like, how, just kind of put things in perspective for us.
I kind of been a hustler, I guess, my whole life. Actually at the time in college, I was selling counterfeit like NFL jerseys and purses and you name it. And that seemed to be some good cash, before, stuff hit the fan. But I was able to put away a decent bit of money that I was able to, fund a trading account with. And I had some help, along the way. Dad, I think, wrote me like a $2,000 check that I've been able to pay back. But, it's humble beginnings, I guess.
Okay. So you said that you were trading, stocks based on momentum and that sort of thing. Is that right?
Yeah. I mean, a lot of chart patterns. I love to draw lines on charts back when I first started. I think, ascending triangles and falling wedges and, flag patterns, pennants, that was pretty much my go-to. So a lot of technical analysis and a lot of, penny stocks. And then I kind of evolved to, I don't know if you call it evolve, but kind of switched paces to, high beta options. So like your Apple, Google, Netflix. And then I was kind of, the same idea. I was kind of just, drawing lines on the options charts or the underlying, and then buying or selling, calls and puts based on whatever my technical analysis was telling me at the time.
Okay. And how were you going through this period? Like, were you doing all right? Were you making money?
Yes, I would have periods where I would kind of, get ahead and get to a new equity high in the account. But I would inevitably give it back. And could never really figure out why. And it just seemed like, it just felt like someone was always out to get me. Like, I'd make some money and then give it back, make some money and give it back. So there's a lot of inconsistency, but, enough success to I think, keep learning and keep, chugging along.
Yeah. So you said that you didn't know why you were giving it back. Now with a lot more experience under your belt, do you understand why you were giving it back in those early days?
Yeah. I really didn't have much of a system, if you will. What really was, I would call it now, I call it escaping randomness. And I never was able to really escape randomness, if you will. So I think if I could simplify it, it's if you have like a coin toss, a coin that's 70% heads, 30% tails. But every time, the first couple flips happen, if they're not winners for you, if you're betting on heads at 70%, you'll make a tweak or an adjustment. But what that does is it kind of restarts you back at, coin flip zero or trade zero. And that's what I was doing. And, you need to flip the coin at, 1,000 times to get that 70% to play out. But if you tweak, something and you go back to zero, you're back in those early coin flips that are essentially random.
Yes, that's a very good point. And I guess this is probably around the point where you started to pursue more of a quantitative approach to trading. Would I be right?
Sort of. So actually, I had big change of heart, kind of change career paths, if you will. And I wound up moving down to Florida and met my boss and wound up taking a job as like a trading assistant at the high frequency trading firm that I work now. I was completely unqualified. I went in there, telling them about how I trade ascending triangles and you name it. And this is somebody that's, worked on Wall Street and worked for Citadel and, a market maker for the CME. And I could just tell that he's like, well, that's not really how I go about it. And that kind of opened my eyes up to, from the way that I taught myself was that there was technical analysis and fundamental analysis. And then I was kind of, my world opened up to this quantitative analysis, this third way, if you will. And that kind of, put me down a whole new path. I had to do it a different way to find, I think, consistency.
So why did you move to Florida in the first place? Did this job come up before you actually made the move, or how'd that work?
I just kind of moved on a whim. Yeah. And God works in mysterious ways, I guess. I can't really explain it.
Okay. So, even though you walked into the office of this HFT firm and you were talking about how you trade with technical analysis and that sort of thing, and, that wasn't how they do it, how did you end up getting a position there with that firm?
So the initial job was, I really just knew I wanted to be involved with the markets. So I really searched for anything. And this job was really just a trading assistant. So I really wasn't initially doing anything that was, making it to the market, if you will. Wasn't getting any money put behind it. So, like you hear the old stories out, people start off as like a clerk or, a runner on the floor. That's, kind of how I pictured, just in modern times, if you will.
And did you try to get any other trading jobs before you landed this one?
No, like I said, God works in mysterious ways. I just kind of lucked out.
Right. Cool. So once you started there, what sort of things were you doing?
Really getting used to just how to look at data, which is not really something is really, preached in the technical analysis world, if you will. It's, it's more visual and they were obviously, much more, not much more, but they are data driven. So, I had to kind of, a lot of it was basically like, creating presentations or taking some of the data and then, making nice reports. But it slowly morphed into where I was able to, do some of the analysis, with basic Excel or, I taught myself how to program. So it, kind of transitioned into a more useful role, if you will.
Yeah. So when you say looking at the data, can you just maybe go into that a little further? Maybe give us some examples of like what sort of things were you actually looking for? What were you looking at in the data?
Well, I think I don't want to get too much into what we're looking at, but I mean, it's really searching for, edges. You're trying to, find some anomaly or, some persistent pattern that, can maybe lead you to make some money.
So once you did find something in the data that looked interesting to you, like what was the next step from there?
So then you gotta test it, back test it. And then from there, you can make a general assumption on, how good is this system, or this edge or this pattern that I found. And then from there, there's a series of tests that you want to put it through before it goes to the market. But at that point, I really didn't understand that. So I had what I thought I found these great edges or systems. And I was like, okay, I'm now down this quant road. I have these systems that have some data behind them. Let's trade them. And I still had inconsistent success. So it's, the learning process went on for years, I think. I mean, it's ongoing, obviously, but never ends.
Yeah. And once you'd been working in this firm for, a little while, did your prior conceptions about trading begin to change like quite a bit? You'd come from the School of Technical Analysis. Now here you were working in a high frequency firm who was all about just looking at the data. Did your prior conceptions about trading change in any dramatic way?
Yeah, absolutely. Just the whole idea of testing everything. Like, you hear a lot of things like, it's bullish if the market's above, whatever moving average. But it's like now I had a way I needed to test this. I couldn't just say something like that without having the data to prove it. And I think that was the biggest thing, is that, there's a book I read, and I hate to give a free plug, but evidence-based technical analysis, where it's basically like there's subjective technical analysis, which is really what I was doing. And now I've transitioned to this objective technical analysis. And I think that's a major key.
Yeah. I mean, a lot of people, when they use technical analysis and they trade in a discretionary way, there's a lot of nuance, if I pronounce that right, to what they do. Was it hard for you to kind of remove that nuance into a way that you could programmatically test it?
Well, I kind of moved away from chart patterns, because I think chart patterns are still, and by chart patterns, I mean like the falling wedge and the ascending triangle, those things I mentioned earlier. I think those are tough to program and test. So I kind of moved away from that. Other than that, I think, you kind of let the data speak to you. You kind of let the data show you where the patterns are, as opposed to going and hunting. I mean, I'm a bit of a data miner now.
Yeah, and that's something I really want to pick your brain about when we get into things in a little bit. Just before we do, though, what are your views on technical analysis these days? I know you've obviously said it's not something you use anymore, but what are your views on technical analysis?
I don't want to discredit it because, things work differently for different people. And I'll never tell anybody not to pursue anything. I think, that was a valuable part of my journey, and it may be for somebody else. But for me, I think I need something, a little more concrete. I think it's a little voodoo magic, if you will, at times. But I think, there are ways that you can use it to actually, gain information. But it's just, you need to make sure the data is confirming.
Okay, sure. Yeah, I mean, that's a really good answer. So I want to pick up on a point you made a little earlier about how you learned how to program. And I don't want to brush over this because it's a pretty big deal. Why did you decide to learn how to program, and how did you go about it?
Well, I more or less had to. I wanted to get out of the trader's assistant role, if you will, and kind of move into, the trade desk. If, everyone wants to be a trader. That's why I got into it. And I realized that Excel, really just wasn't going to cut it with the amounts of data that high frequency, firms go through. So I knew I had to program to get to the next level. And to be honest, to me, I think learning to program, it's the best trade I ever made, because if you think about it, the risk on it is very small, but the gains on it, it's asymmetric risk reward, hands down. It's the best trade I think somebody could make. And I look at it now as it's a superpower. I couldn't imagine trading without programming now.
Why do you think it is a superpower, like you say?
I just, for example, you see someone on Twitter, they'll mention a stat, and I can instantly go and program a couple lines of code to look for that same stat, and I have the same information. Or, you have an idea in the middle of the night or in the shower, I can instantly go test it out. Or just the whole idea of data mining in general is I can burn through, and people will probably hate that word, burn through, but I can whip through data and find patterns way faster than you can by hand. It's just such an advantage in so many different ways.
Yeah. So how did you actually go about learning to program? Like, where did you kind of start?
I think I read, a handful of textbooks. So C++ is obviously the main language we were using for the high frequency trading, just for gives you the fastest response time, if you will. So that's, I kind of just picked one, knowing now that's probably a fairly difficult one to start with. But I read everything. I watched, YouTube videos, tutorials, Coursera, free courses. There's tons of resources, but I just had to, kind of be diligent, and was lucky enough to find, some people that would answer questions, when you get stuck, because, it's no easy task, but it's worth it.
Yeah. So how long did it take you to become somewhat fluent with our language? I think you said you started with C. Was it C+ or C? One of those.
Yeah, C++. They're kind of learned them at the same time. Really didn't understand the differences when I first started. Never really been exposed to, anything in that field. But yeah, probably took, a couple months just to get like a basic understanding. But I kind of had an advantage of, being around programmers, all day and talking to them and being in that environment probably made it, quite a bit easier. But yeah, it's a time consuming task without a doubt.
Yeah. So when you say it took you a few months to become somewhat fluent in this programming language, is this something you were just doing after hours, or is this something you were doing, during the day at your job as well?
Yeah, I actually had the luxury of being able to do it on the job. I'd expressed to my boss, who's I couldn't speak highly enough about, but he was able, he put some some basic tasks, if you will, together for me to kind of speed up the process for me. So I built like technical analysis libraries because he knew that's what I was familiar with in C++, and I think that's probably a good way to start. For anybody is, learn how to just read in data and then just, learn how to build a technical indicator, whatever your favorite one is from that, open, high, low, close data. That's essentially how I started.
Yeah. So do you have any other advice for someone who is considering learning how to program, like any tips or pointers for how to maybe speed things up a little bit? Because it is quite a big task, quite a big challenge to take on.
Yeah. I would say to make sure you, one, look at a few different resources, because I would read something and be stuck. And then I would read the same concept in another book or watch it, on a YouTube video, and it would completely click right away. So I think, sometimes you just don't see it from the way that author presented it. And the second one is try to find people that do it, that you can ask questions to. Because you'll inevitably get stuck. And to me, being able to go to my boss or, someone else and say, hey, I have no idea what this means. And I've looked at 2 different resources or 3 different resources. I'm still stuck, and that you're going to need that, I think.
Yeah. And that first point you made, that's actually a really good point about looking at multiple resources. And, for anyone listening is probably aware that I've been learning how to program over the last 12 months or so. And Stack Exchange is awesome for that because, someone will post a question and pretty much every question you could think of has already been asked on that site.
Yeah, I still use that every day. I mean, that's a lifesaver, without a doubt.
And you see like a bunch of different answers to that question and different ways of doing it. And some ways are a lot easier to get your head around. They might not necessarily be the cleanest code. Usually the easiest sort of things to implement have the code's not as efficient as it could be. But yeah, it's good because you can see, different ways of doing what you want to be able to achieve. So yeah, no, good advice. And why did you decide to learn multiple languages? Like you started with C++. I know you also know, I think it's Java and Python now. Why did you decide to learn more than just the one? Well,
one was we use primarily a few in the office, so that was it was almost out of necessity. But I think it's beneficial because I think certain tasks lend itself better to different languages. Like I think like the higher level languages like Python and Perl or R are real simple for just doing like the basic data analysis and searching for edges. But, if you really go to implement some highly complex strategy, you're probably going to want something with a little more control, like, C++.
Okay. So for anyone starting out, what language would you suggest?
I think Python. I actually was just talking to a buddy of mine, and he's been talking to recruiters for, quant jobs, and they all are like demanding Python. And to me, it's relatively clean. It's simple. There's so many open source libraries, free resources, and it seems to really be, growing in finance. It's almost like I felt obligated to learn it, to be honest.
When you're talking to your buddy who's looking for people who know Python as a programming language, what sort of other qualifications are they looking for? Are they just looking for someone who knows how to program in that language, or are they actually looking for some sort of higher education certificates?
They did. I think he mentioned, machine learning background is obviously preferred now. That seems to be the big buzzword. But other than that, I think it's probably, statistics, probability, anything math-based, physics is probably, high on the list. But yeah, I don't have much experience, to be honest, with that.
Yeah. No, that's cool. So let's talk a little bit more about your trading, your kind of approach. You hinted earlier that, you describe yourself as a bit of a data miner. Usually that's not a good thing in a trading sense. Usually when people hear that, they think, overfitting and that sort of thing. But explain to us why you kind of consider yourself to be a data miner and why that's not such a bad thing.
Okay. I just think there's just so much information. There's so much data that there's edges out there, but I may never find them just by pure luck. Like, I think, we talked briefly about, if you start with, this moving average cross of a 10 and 20, and I start with, 30 and 40, and yours turns out to be terrible and mine seems to work well. And then you keep searching until you eventually find mine. Are you data mining, or was I just lucky that I found it originally? And I think if you do enough to prevent against, the overfitting, and the over optimization, I don't think there's anything wrong with using the computer as a search tool and to find these edges.
Yeah. So as a data miner, let's just call it that, as a data miner, okay. What are you actually doing to find edges? Like, how are you finding edges in the data? Are you running machine learning algorithms and using machine learning techniques?
Yeah, I've done that, and you can be simpler than that too. But now I just kind of have built this almost master program, if you will, to kind of just you search for a fitness function. Let's say P&L to drawdown ratio or profit factor or win percentage or whatever it is you want. And you kind of just, search all these different combinations until you find strategies that, meet this threshold for that fitness function. So that you say, hey, I only want strategies that have a profit factor over 2.5, and you just run the search program until you find, X amount of strategies over 2.5 profit factor.
Okay, so doing this sort of thing, do you have a hypothesis to begin with? Like, do you have the sort of edges that you might discover? Is there almost a fundamental reason for why that might actually work? Or you purely just, if the data shows there's an edge there, that's all you need? Yeah,
I don't have one going in. I just kind of am searching, like you said. But if it does seem to make like logical sense after I found these strategies, then I would put a little more confidence behind the ones that seem to make sense on their own.
Okay.
If that makes sense.
Yeah. And just so we're clear here and, we don't lose anyone, when you talk about finding edges, how do you explain that? What are edges in your view?
Oh, geez. We could probably do a whole podcast on this. Like, a simple way would just be something that has a positive expectation. So if you think of like the coin flip game, it's 50-50 chance of landing on heads or tails. But if the payout on heads is 2 and the loss on tails is only 1, then you would have a positive expectancy. And I think that's probably the simplest way that I could explain like edge. Like, that's the most rudimentary, explanation. There's plenty of ways that people define edge.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, as we're talking about data mining here, and also mentioned that a lot of people, when they hear data mining in a trading sense, immediately think curve fitting. What sort of measures do you take to prevent curve fitting as much as possible?
This is I think the most important part if you're data mining. So a few simple ones. I don't know that I want to give away all the sauce, but I think you need a minimum number of trades, in and out of sample testing, cross validation, where you would basically slice the data into pieces and test on the different pieces, keeping one of the pieces for out of sample and rotating that each time through. Some other ways are, making sure you don't use parameters that lend themselves to optimization, like looking at patterns, for example, is the high above the high of 2 ago is much better than just picking a moving average and finding the best length. I think, we could probably get deeper into that, but that seems to be a big mistake with data mining. A lot of people associate it with just optimization.
Okay. Yeah, well, let's break those few things down a little more. So minimum number of trades, how do you think about that?
Okay, so for every, rule in the strategy, I would like to see a minimum number of trades. So if I have, 3, 4, 5 rules in a strategy, then I want, at least 500 times each rule. So, 300 trades, I need 1,500 trades. Or 3 rules, rather, I need 1,500 trades, just to make a simple example.
Okay. So do you just want to explain, I think that's a good point you bring up, but do you just want to explain why you want more trades for the more parameters or rules that you have in a strategy? That's
tough for me to say. It generally has to do with allowing the law of large numbers to play out and make sure that you found something that's real. Like, for example, if you flip a coin, and again, to go back to this, but if you get 7 heads or 8 heads out of 10 flips, it's tough to say that coin is really 70 or 80% likely to land on heads. But if you were to flip the coin 1,000 times and it came up, 700 or 800 heads, then it's much easier to conclude that that's, not a fair coin. And I think the same thing can be said about trading. If, you only have a small number of trades, it's tough to say that that's a real, robust strategy. But if you, can show that the edge persists over a large number of trades, then you have much more confidence trading that, moving forward.
Yeah. I think it's probably also fair to say that the more rules that you add to a strategy, the easier it is to curve fit as well. Would that be correct?
Oh, yeah, absolutely. Yeah.
So how do you split up your in and out of sample data? Do you have a certain ratio that you like to work with?
Yeah. So usually I'll default with 35% out of sample, but I'm actually researching this now because moving that window size is actually resulting in me finding different strategies, which that's obviously I'm still working on why or how or what that means.
So you mentioned something very interesting to me, and that was about how you try to avoid using indicators or parameters that have a look back aspect to them. So that might be the highest high of the last 10 days, just as an example. If those are the sort of things that you try to avoid as rules for your strategies, what sort of things do you like to be the signal, or what sort of things do you like to focus on in your strategy?
Well, without giving away too much secret sauce, I think like non-parametric things, like I think, like counting measures are valid, and things that, I don't know how far I want to get, down this path, but yeah, like I think it's okay to use technical indicators and stuff that have look back parameters, but I just don't think it's smart to optimize those look back parameters. I think if you want to use one as like a regime filter or something like that, that's completely valid, and that's something that I'll do. But to optimize, should it be the 19 or the 27 or the 50-day moving average? To me, that's kind of murky water.
Okay. I mean, when you said counting measures, what's that referring to?
Like you could count consecutive higher highs.
Okay.
Or, consecutive, negative closes or something like that.
Yeah. Looking at your Twitter feed, you post a lot of screenshots of kind of signals that your systems are generating. They seem to be very focused around volume and volatility. Do these sort of things play a big impact?
Yeah. The two things that I really tend to like to look at. I think that like market regimes are very important, and I think that volume and volatility are great tools to put context around the market and define, kind of refine, I guess, what your expectations should be.
Obviously mentioned that your Twitter feed there. You posted on Twitter, this must have been a few months or a couple months ago, a really interesting graph. And on the left-hand side, it showed an equity curve just on its own. And then on the right-hand side, it showed Monte Carlo analysis or distribution. Mm-hmm. And you drew in that Monte Carlo analysis where that equity curve actually sat. And I thought it was a very powerful graph. I'm actually going to pull it up, and I'll put it into the show notes at chatwithtraders.com because I'd really like everyone who's listening to this to actually see that graph. I think it was very powerful. But I think a lot of people perhaps didn't really understand what was going on there. Would you like to explain the graph to us and make it, I know we don't have any visuals to guide us here, but just try and make it as simple as possible to understand what was going on there and why it's important to, I guess, understand this.
Yeah, I think there's like three key points that kind of turned my trading around. And I think all of them have to do with having unrealistic expectations. And I think like the simplest example is if you take a backtest drawdown, and then people will kind of size their system or allocate enough money to that system based on, that worst case scenario, or maybe they take the backtest drawdown times 1.5. And that's kind of what I was doing, and that just wasn't enough. So then I learned about Monte Carlo simulation, which is basically a reshuffling of the order of the trades in its simplest form, and kind of recalculating an equity curve for each one of those reshuffles. And that's essentially what that graph that you're referring to is. And I think if you look at the single equity curve that I hand drew in to the Monte Carlo equity curves, you could see that back test was at the very top of the distribution, or it was one of the best performers, if you will, of the reshufflings. And to me, people will look at the single back test and think that, oh, wow, this made, I don't remember in that example what it made, but it made, let's just say it made 50 grand in, 100 trades or something, to keep it simple. And if you look at the distribution, or the Monte Carlo curves from the reshuffling, 50 grand is highly unlikely to repeat itself in the next 100 trades. So when people begin to trade, they'll realize, after 50 or 75 trades that they're nowhere near that, that they're not going to make 50 grand in 100 trades, and they think that their system is broken. And it's not really a matter of it being broken. It's just a matter that you had unrealistic expectations going into the next 100 trades. And I think looking at that distribution and knowing where your equity curve is in that distribution helps you create more realistic expectations and can contribute a lot to survival and then ultimately success.
Yeah. Now it's a really important point. And like I said, I'm going to dig up that graph and I'm going to put it in the show notes at chatwithtraders.com. It'll actually be chatwithtraders.com/ the number of this episode, which I'm not sure what that is at this point. But you also talk a lot about variance testing. Is this much the same thing, or is variance testing slightly different?
So I have variance testing. It's similar in a way. But I noticed a big problem that I had when I was trading was, if you would have asked me, where do I expect to be in the next N trades, the next 100 trades, 500 trades, I couldn't have answered that, even a few years ago. And it's much more complex than just the average trade amount times that number of trades. You really need to think of it as a distribution or a possibility of outcomes. So this variance testing is essentially, it's like a simulator that takes the winning trades, the losing trades, and your winning percentage, and it creates these 1,000 hypothetical equity curves of where you could be in the next N trades. This is actually software I'm, working on building, to release to the public. But I think that knowing where to be in the next N trades is really important to success. But then with variance testing, what that is what if you vary your win percentage? Is your strategy still profitable? So what I do is I'll take a back test, and let's say it has a 61% win rate. But I want to know where will I be in N trades if in the next N trades, my winning percentage is only 55%. Is it still a viable strategy? And I think this type of, simulation is kind of missed by a lot of systems traders. And I think it contributes to the unrealistic expectations. I think you have to have a range of outcomes based on a variety of possibilities, because as we know, the market is never gives you really what you want.
Okay, Dave, well, let's talk about the 3 laws. I think you described it as 3 laws which you trade by. So let's spend a little time on each of these. I think they're each really interesting. Obviously, we were talking about these off air. Number 1 is you said that you much rather prefer asymmetric risk to reward. Would you mind explaining that for us?
Yeah, so I think you need to have bigger wins than losses. I think you want to have long vol characteristics as opposed to short vol characteristics, or probably better to say more like trend following versus mean reversion. Because, and what I mean by that is, I'd rather have a lower winning percentage but a higher payoff than a very high win percentage and a very low payoff. Because I think as you move into real trading, you take a system from production and testing and you take it to live trading, the randomness happens and you never really get the expectation from the back test or whatever testing you want to do. And I think it's safer to be, have the long vol characteristics as opposed to the short vol characteristics. So I tend to prefer, bigger wins than losses, and I'll sacrifice a little bit of my win percentage to achieve that.
Okay, that's fair enough. And number 2, I think there's probably a better way to phrase this, but I think you said that all bets mean the same thing to your bottom line. I'll let you explain that one.
Yeah. So let's say that you have 10 systems that all have relatively the same characteristics, or you want to take even for discretionary traders, you want to take 10 trades off of the same pattern whenever they appear. It would not be in your benefit to have one of those trades be done with 5 times the size as the other 9. Because if that one that you size up on wipes out, 6 or 7 other winners, then you're really at a disservice to yourself, because you're really not allowing, and I don't want to give away the third law, but you're really not allowing, the expectation, the math to play out. You're kind of just putting all your eggs in one basket, even though you're making 10 trades. One of them, means a lot more to your bottom line.
Okay, so you're obviously saying this from the position of being a quant. For discretionary traders who do, size up on certain trades and do risk more on certain trades, do you think that type of approach is flawed in some way?
Yeah. Like I said, I never want to discourage anyone from trying or testing anything. And what works for someone else or doesn't work for me, may work for someone else. So I'll, disclaim with that. But I do think that that's dangerous. I really try to avoid excitement in my trading. I think trading should be boring. And I want the expectation to play itself out over the 1,000 coin flips, as opposed to having, 10 coin flips and you decide you want to bet your whole lot on the 8th flip. To me, that's kind of crazy. If you want to bet your winnings from, the 4th through 7th flips on the 8th flip, that to me is crazy. I kind of just want to stay in the game and I want to get to my 1,000 flips, if you will.
So that, of course, leads us into the third law that you trade by, and that is the law of large numbers. You want to execute your edge as much as possible. Do you want to explain that one a little further?
Yes, I think we kind of brushed upon it earlier. And again, to go back to the coin flip, if you have an unfair coin, or it's 70-30, I think was the numbers we used before, and you flip it 10 times, you might find that the tails, which was the 30%, might happen 7 out of those 10 times, or 8 times out of those 10 times. But if you flip that coin 1,000 times, then that heads that had the 70% chance is going to be around 700. And I think it's important, if you do the research and you find a positive edge, to allow that positive edge to play out. If you only do a couple of, trades or coin flips, you might not experience what the expectation is just because of randomness. And like I said earlier, you need to escape that randomness. You need to get to, a lot of number of trades to assure, or ideally to assure, that your edge will play out.
Yeah, so I want to ask you a few questions around this because, this is something I've been given a little thought to lately myself. How do you actually increase the number of trades that your strategy produces?
I don't know that you can take an existing strategy and increase the number of trades. I think you probably have to, change timeframes or change, the actual strategy itself. I think that's kind of dangerous water to just try to get an existing idea to trade more.
Well, that's kind of what I'm getting at. Like, because you want to tap into the law of large numbers, will you only trade a strategy that's perhaps an intraday strategy, like end of day strategies? You've only got a limited amount of data and obviously they take a lot longer to play out. Are you only focused on intraday strategies? Are you only focused on trades that, hold for 2-3 hours?
Yeah, I think obviously like the higher frequency data lends itself, to that, the law of large numbers is obviously much better. I think that's why there was such a migration towards that, that industry when computing became so prevalent in finance. But I think it's okay to still trade like daily timeframes and stuff. And I think like the variance testing I do or the Monte Carlo testing I do, if you're happy with those simulation results and they show you that, in let's say, 100 or 200 trades, this is where you can expect to be, and you're happy with that distribution, then that's fine. You can still find, I think, strategies to do that. I just think it's easier to get to a higher number, obviously with higher frequency data. And it doesn't have to be high frequency data, just, half an hour bars, 15-minute bars or something like that.
Yeah. Okay. Would you ever consider, like, I don't know how you approach strategies in this sense. Like, do you create strategies that work on one market? Like, you might try to create a strategy that works on the E-mini S&P 500 futures. If you have a strategy that looks somewhat promising on that market, but the number of trades aren't high enough for your liking, are you going to bring in other markets and try and bring those into the basket of markets that your strategy trades on?
Yeah, that's definitely a way to go about it. You can definitely do that. It's not necessarily something I do. I do like to see robustness across markets, but I will kind of shy away from something that I don't think has enough trades. So it's tough for me to say. But yeah, I think robustness across markets is definitely preferred, although not needed, assuming you have enough trades.
Yeah, and while we're still on this point, I'd like to ask you, how do transaction costs factor into this? Like, is there a point where you are better off trying to make more profit on each trade rather than trying to take more trades? Because each time you take a trade, you've got slippage, you've got brokerage fees and whatever else. Is there ever a point where, it pays to try and look for more profit in each trade?
Yeah, I think it is difficult, with like a retail account to allow this to play out, this law of large numbers, because you do run into very high transaction costs. But I'm not exactly sure how you can really combat that now that I think about it. And I'm kind of, in a situation where I haven't really had to think about this problem in a while. But I think there's probably some happy medium where you can get a strategy that doesn't kill you with transaction costs, but maybe doesn't have, 1,000 trades, maybe only a couple hundred or something. But I think it comes back to that, that variance testing and where do you think it's going to be? And are you happy with that distribution? Is it something you're willing to allow to play out or no? And you have to obviously factor in your transaction costs into that simulation.
Dave, I'd like to ask you a couple questions about high frequency trading, just in general, about the industry, as someone who's on the inside. Usually, I guess kind of in the media, HFT cops a really bad rap more often than not. Why do you think this is?
I hate to be the spokesperson for all of HFT. I think it's tough for me to say. I think a lot of the bad rap it gets is from like the Michael Lewis book and what people call like latency arbitrage, which is actually not something that we do because we only trade futures through the CME. So we're only one exchange. And I think, the HFT, it's also very easy just to find a scapegoat. The trading is very tough. And I think, sometimes people just look for a scapegoat. I'm not so sure that a lot of the bad rap is justified. But I'm biased.
Yeah. No, that makes sense. And, as someone who is involved in high frequency trading, do you yourself see any negative aspects to it?
No. I mean, I think I'm biased, but no, I don't think, at least from my view, it's like, nothing, we don't do anything predatory. I'm not so sure that I, believe the claims in, that the book I mentioned. And no, I don't think it's bad in any way. I think, if anything, it's probably beneficial. And, I know people can find articles on both sides of this coin. But yeah, from my view, no.
Yeah. So how is the HFT landscape different from equities and futures? Like, is there perhaps some negative aspects about it in the equity space? Because obviously the market structure for futures is totally different.
Yeah, I just think that's like the one area that people really dislike is that the whole idea of, like I said, latency arbitrage, but where people race from exchange to exchange, or at least that's what people are, speculating is happening. And I think that is, that's a tough call, and a lot of different opinions on that, but it's, like I said, it's not something that we do, and it's not something I'm, too versed in, to be honest.
Yeah. And when we were speaking before the call, you said to me that you think the heydays of high frequency trading might be coming towards an end. What do you think the future has in store?
I don't know if it's coming to an end. I just think it's obviously much more difficult as time has gone on, as more people come into the space. And a lot of the strategies, get exposed, or people jump from shop to shop or something like that. But I think it's tough because we kind of have this debate in the office on, is it what I just mentioned? Is it, too many players and too efficient, or is it just kind of a product of the monetary policy, laid out by the Fed and the other central banks? Because that monetary policy, it really isn't conducive to a two-sided market, which is obviously what HFT needs. So it could be a mix, and I'm sure the truth, always lies somewhere in the middle. But yeah, it's obvious. It's definitely getting much more difficult. But to pinpoint my finger on it, I'm not sure.
Sure. Yeah. I mean, I'm actually hoping to get Manoj Narang on the podcast. We've actually been scheduled like 5 times to do the interview, but he's a busy man and hard to pin down. So I'm really keen to get him on and get his take on all of this.
That would be great.
I had his brother on, Rishi Narang, on like episode 54, I think, somewhere around that point, and he was awesome. Big fan of his book also.
Yes, yeah.
Anyway, Dave, this has been really good, man. I've thoroughly enjoyed this. Now, some of the things we've talked about here are a little bit tricky to implement and test and that sort of thing. You've been working on a software package, Build Alpha, I believe it's called. Do you want to just tell us a little bit about what you're working on and how listeners might be able to benefit from using that?
Yeah, that'd be great. And I enjoyed doing this too, by the way. Thank you very much for the opportunity. But yeah, I'm putting together some software that essentially would allow. I've been using it for a while, but I'm kind of building a public version that I'm thinking about licensing out. And what it will do is it basically would allow you to select from a list of signals. Maybe 500 at a time, 1,000 at a time. We're kind of working on the memory right now. And it would search for different strategies based on the exit criteria you provide it, and the fitness function you give it. And the fitness function, win percentage, payoff ratio, profit factor, Sharpe ratio, something like that. And all this is kind of built in. And then what it would do is it would search for these strategies and find the best ones given that criteria, those signals, and the fitness function. And then from there, you would be able to view the strategies, their equity curves. You would be able to run Monte Carlo analysis on it. You would be able to do my variance testing on it. And you'd be able to generate tradable code for each and every strategy. And I'm actually working on, being able to create portfolios. You can kind of pick and choose from these strategies it finds the one that create the distribution you like, and then add them to a portfolio. And then you can kind of analyze the portfolios the same way. So I think this is really cool software, and it is kind of like the culmination of, the tools, and the process that I go through and have gone through. And I, kind of want to share it, and maybe I can help some people, speed up their learning curve, or, even, find some strategies or get an idea of how to go from signal to live trade.
Absolutely. So where can listeners go to find out more about this? Like, is it available at the moment? Do you have a website up for it? What's the deal?
Yes, I do have a website up. Hopefully by the time this airs, it'll be finished. We're, 95% done, I think. But it's buildalpha.com. And you can reach me at david@buildalpha.com, or at dburgh, DBURGH on Twitter.
Awesome. Buildalpha.com, and follow Dave on Twitter. Dave, once again, man, thank you very much for doing this. I truly do appreciate it.
Hey, man, I appreciate you letting me on. I'm honored. I think you're building something really cool here.
All right. Thanks, man. We'll talk soon.
All right. Thanks. Take care.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
unlimited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? Big thanks for being here. On the podcast this week, I got the chance to catch up with Alex. We will keep his surname private, but he goes by AT09_trader on Twitter. Alex is a 22-year-old discretionary day trader who has seen really great results in the few years he's been grinding away at this. He trades small caps and he trades aggressively. As you'll soon hear, Alex is far from conservative. This conversation was recorded on the 16th of November after the close, right around the time when the madness in the shipping sector was unfolding. So we got talking about the ticker DRYS, how Alex racked up a $40,000 loss a day or two before our interview, although I should also mention he had his first $100,000 day shortly after too. We also spoke about how Alex got started, the types of trade scenarios that he looks for, areas that he's working on to improve, and also his venture into real estate, where he flipped a foreclosure property for a tidy profit, plus much more. Now, I'd like to remind you that nothing you hear on this episode, or for that matter, any episode, is to be treated as financial advice. Please remember, you are entirely responsible for your own trading decisions. And as this is the last episode before the 25th, I'd like to say, please have an awesome Christmas, enjoy time with your family and friends, and prepare yourself for a big year in 2017. Merry Christmas. Now let's go. Here's the conversation I had with Alex. Usually on this podcast, we don't talk specific about particular trades or certain events because it sort of tends to date things a little bit, but DRYS, the ticker for dry ships, this one we can't ignore.
Yeah, it's all over everywhere. Everyone's talking about it. CNBC is even talking about it.
Yeah, this is one for the history books. So, I mean, I'm really keen to get your take on it. How have you been trading it? When did this first come onto your radar?
I mean, okay, so basically I first saw it, I think it was that day, it was like very low volume. I think it went from 8 to maybe 16 or something like that. Slowly started to fade off. And then I really started to pay attention. I think it was the day after when it had a little bit of a weak open and then pushed towards 18. And then from there, I think just it trapped everyone. Everyone got stuck. It was just weird thing. Like I thought it was just going to be like a normal, a short squeeze after a couple of days, come back down. Nothing crazy. We've seen it a million times. All like these big traders that I speak to or I know of, they're all shorting, they're very comfortable. It's like nothing crazy. And then out of the blue, it rips faces off. It just blew my mind. I luckily did not have to borrow for it. So I'm sure I would have been one of those guys that got their balls squeezed too.
So why did that happen? Like, what was the driving force behind this? I mean, even to start off with, $8 to $16, that's a pretty big move in itself. Like, what was the driving force that led it to continue? Because, just to put things in perspective for people who might be unfamiliar with this or who haven't seen the chart, I think it was early November or even October, it was just trading at it was less than $1.
It's a reverse split. It just keeps selling off and then reverse splitting.
Right. And, it went from under $1 to over $100 within like a matter of like a couple weeks?
Yeah, not even a couple of weeks. I think it was Friday to what's today? Today is Wednesday. It hit 115 today, pre-market.
Yeah, it's a ridiculous looking chart. What was the driving force?
So what I think the driving force was the short sell restriction. I think was a big part of it. So the float is already low. I think it's less than a few million shares, whatever it is. And the problem with SSR is that once like it goes high enough, the stock goes high enough, there really is no more sellers to push it down because they're not going to be selling on the bid. They're all comfortable. Everyone's fine. It's just going to be shorts putting it on the offer. As soon as the shorts are done, it's just going to keep ripping and ripping higher. And it's been a long time since we had one of those black swan squeezes. So a lot of shorts just felt really, really comfortable and they just got destroyed. And I mean, like, I would have been one of them too. If I had to borrow, I would have been smoked as well because we're all used to seeing these charts. We're all used to seeing these parabolic charts. And I guess just sometimes if you don't stick to your rules, all it takes is one day to blow you up forever. It's a scary thought, honestly.
So were you involved in trading this at all? I mean, you said right there you couldn't get the borrows for it, but were you trading the long side?
Yeah, I couldn't get the borrow, but I was trading the sympathy plays. Like I think it was EGLE was one of them. SINO was another one. TOPS was another one. So basically, the way these sympathy plays work is that they fuel off the main runner. So call DRYS the head of the snake, and everything else just falls in its path. So as soon as the head of the snake gets cut off, these stocks collapse with it. So my thesis was I couldn't get the borrows on DRYS. Why not short the sympathy plays? DRYS is not going to last forever. It's going to fall down. So these stupid stocks should fall too.
Okay, so these other stocks were up significantly as well?
Yeah, I think they were up like 30, 40%. This was on Friday. So even before the crazy squeeze started, as soon as the massive squeeze from like, was it $30 to $60 to $90 to $100 started, these things started to go ridiculous. For example, I was short SINO. I think I had like a $1.90 average or something like that. I managed to cover a few $1.60, and then I started adding your 2 and your 230, and then I was forced to cover. I was losing too much money. Turns out the next day, trading at 3 pre-market, then goes to 4, then goes to 5, 6, 7, and like it almost hit 8 the same day. And then sold back down to 5. And now today, and after I was trading, it's above 8. It's at 860. So that could even go even higher. It just blows my mind that, a couple hours ago or a couple days ago, I was covering my short at $1.60 and I couldn't fill all the way. And now it's at $8. If I didn't stop out, that would be the end of my trading account. It's just so scary to think that 1 or 2 days of just stupid trading or irresponsible trading, not sticking to your rules, could destroy you. It's scary. It blows my mind.
Yeah, I think there's a number of traders who have probably been hurt by this quite badly. So these other stocks, when you're talking about these sympathy plays, these other stocks really have no reason to be up by the crazy amounts that they do, other than the fact that they're in the similar sort of industry and sector as, in this case, DRYS. Is that what you're saying?
Exactly. So most of these stocks they're like garbage. So they have to raise money. They have ATM, warrants, everything. They're looking to raise as soon as possible. So my thesis on these sympathy plays is they're usually not going to run as hard or as fast or as high as the main one. So they seem a little safer to short. But when craziness like this happens, where DRYS hits 115, these things just lose their minds. They have low floats, some of them under 3 million shares. And it's crazy. For example, SINO has a float of, 2.8 million. And today it traded almost 42 million shares. The float rate rotated almost 12 times, 13 times. And it just keeps going up and up. Shorts get trapped and they have to keep covering to get out. It's crazy. It really is.
So, I mean, a lot of these stocks are still up quite a bit at the time that we're recording this podcast. I mean, how do you anticipate this is going to play out from here on?
So I guess I want to backtrack a little bit. So if these stocks, are going up, like why would I short them? Why would I not buy them is what I guess a lot of people are talking about. Like, why not buy it? You have 200% upside rather than, blowing your account or something. And the reason for that is like, I'm terrified. I'm terrified of buying because today DRYS was halted. What if the next shipper gets halted? And I feel like I'll have that bad luck where the day I buy that stock, it's going to halt, so I avoid it.
Okay. Now, I saw you posted on Twitter, it was either yesterday or the day before, before when we were recording this, and we're recording this after the close, which on the 16th of November, 2016. You mentioned that you lost $40,000 the other day.
Yeah.
I got to ask you about that. What happened?
Yeah, so I was short one of the sympathy plays, EGLE, and I had some SINO as well. So EGLE, I had around 35,000 shares at something in the sevens average. And when DRYS was starting to pull back near like 45, I was confident that the stock was just going to fail back to 5 or whatever, Like I said, we've seen it a million times. Why is this time going to be different? And it just blew my mind when DRYS went from 45 to 65, broke a new high of the day, and I just had to get out of this EGLE stock. I took my loss on that. I took my loss on SINO, and before I knew it, I was down 40 grand. It sucked. It was a terrible feeling, but looking back now, I would have been down 100 grand or 120 grand if I held like an idiot,
Yeah, so obviously I presume that, you didn't anticipate to lose that much money going into this trade. Like you weren't prepared to risk that much money in these trades or that day. What went wrong?
What went wrong? I underestimated the staying power of DRYS. The stock is truly a black swan stock. It's like the KDIO, AQXP, all combined, It just, for a stock to go from 5 to 115 in less than a week is just something that you don't see every day. So these stocks are acting the way they don't. So in my mind, I say, I'm going to short it. I could be a little bit patient. Maybe I'll be down 10 grand. It's not going to be really much of a big deal. But if you don't stick to your rules, if you don't respect the chart, then, you could blow up in a day. It's really as easy as one bad day could screw you forever.
It's very true. It's very true. Anyway, man, let's get into some more. Let's rewind a little bit and let's talk a bit about how you got into trading. I know you've got a unique story around this. So, tell us what led you into trading. How'd you get into it?
Yeah, so basically it starts with my dad. So he came from Turkey to the States in the 1980s with his brother. So he didn't really speak any of the language. He didn't really have much money, but he was an entrepreneur at heart. So he started his own electronics business with my uncle, and it took off. In the 80s, electronics was hot. Everyone was buying left and right. Like, he really made a name for himself, and the money started pouring in. He started making a lot of money. And I guess for as long as I can remember, money was never an issue in our family. My dad had a lot. He worked really hard, and everything came really easy to him. So I think it was in the 2000s or whatever. He had a little extra money on the side, and he said, what do people with extra money do? Put it in the stock market. So he put his money in the stock market, and I guess I was younger at the time. I didn't really understand it, but all I can remember is he just kept making money. He would put in like some blue chip stocks, like nothing crazy, just like, I guess, watch it over a couple of days, not really day trading, it just, I guess, investing. But long story short, 2008, 2009, whatever it was, when the whole economy went to shit, people weren't buying things anymore from the electronics stores, and quickly our lives changed. Everything changed immediately. From having a lot of money, we went to having almost no money instantly. It was just big change. I think I was 15 or 16 at the time, and I didn't really understand it because I was so used to like everything coming easy to my dad. And it's I guess it's just a crazy story. So when I turned, I think it was 16 or 17, I had like a pretty decent car. I bought like some rims for the car, nothing crazy. So I thought in my mind, if my dad was making money in the stock market, why can't I do the same? We don't really have that much money anymore. I don't want to ask him for money. So I sold my wheels for, I think it was like $2,000. And I put it into like a TD account or an E-Trade account. And I just started like playing some stocks. I heard I didn't find like much traction. I was mostly buying stocks and just losing. I was the guy buying at the top, and it was a terrible time. So I guess I was looking on like the online forums and whatnot, and I found like a penny stocking guru or whatever. So I subbed to him for like $100 or whatever it was, and I said, if this guy could do it, why can't I? What's stopping me? I'm sure I'm smarter than like most people. So long story short, I followed his trades and I lost a bunch of money. So I said, screw it, trading's not for me, whatever, I'm done with it. So I got a job at Starbucks. I started working a little bit more. And I said, I'm a smart kid. Maybe the first time it didn't work. Let me research a little bit more and let's see what happens, So I took the money I made from Starbucks. I put it into, I took the money from Starbucks. I bought a subscription for another chat room and I learned about what shorting was. And this concept blew my mind. I said, if I'm buying at the top and the stock is going down, what if I just short where I was going to buy and, make some money? So there was a light bulb that went on in my head. So I found a broker that allows shorting, an offshore broker. And I put what money I had in there. And I think the first short trade I ever had was, I shorted 2,000 shares of VGGL at like $4. And within like 10 or 15 minutes, the stock went from $4 to $3.50, and I was up $1,000 instantly. And just, I can't explain to you the euphoria I felt. It was just, I was on top of the world. I felt like a king. I made $1,000 like from one trade, and I was hooked forever. I couldn't stop. Shorting became everything to me.
What a story, man. So just backtracking a little bit, when you first opened up that trading account, did you blow up that first trading account, or did you just decide that you were losing too much and that it wasn't for you?
The 2000 account, I blew it up. I blew it up after a couple trades. It was gone before I knew it.
And was that the only account you've blown up to date?
I've blown up a lot. I can't even count. So after that VGGL trade, I started to pick up traction, and then before you know it, I was doing stupid stuff again. I was shorting anything that was up. I had no rules. I said, this stock is up 20%. Let me short it. What's going to happen? And after I started losing that money, I just kept, I kept working at Starbucks. I kept my job a little bit. I wasn't really making that much, but after blowing up like 5 or 6 accounts, these are small accounts, like say $1,000 or whatever. After blowing that up enough times, I said, what would work on the short side? What are all these big traders in this chat room doing that I'm not doing? Like, what am I missing? What is the golden road? What is whatever it is, what is the secret sauce of trading that I'm missing? And the thing is, I found, I guess the strategy that most people were using was they're shorting stocks that are trash, that don't really have any reason to be up. And long story short, that strategy worked a lot for me. And then I evolved that strategy into shorting the sympathy plays of running stocks. So mostly when these stocks run, like the sectors run, whether it's forklifts, Ebola, whatever it is, they usually have sympathy plays that other people are chasing or wanting to be that next big runner. Most of the time, I guess with smaller accounts, you don't really have to borrow for that big one. So I found that having to borrow for these sympathy plays was not only cheaper, it was also a little bit easier,
So you said that you were trading accounts that were only a couple grand, and I think you even said maybe one was like $1,000. Like that's pretty tough going. Like how were you managing to trade with such a small account, and how did you get around the pattern day trader rule?
Okay, so I use one of those offshore brokers that allows you to have like a $500 account minimum, and they give you 6 times leverage. So let's say you have a $1,000 account, they let you have $6,000 in buying power intraday. So that led to my blowing up happening even faster, because I was playing on margin, and just losers just start to add up and add up and add up until I said, screw it, I can't lose anymore. I'm sick of this. Screw Starbucks. I want a better life for myself.
And now these offshore brokers, that in itself, it sounds very dodgy. Is it dodgy? Are there any risks of using a broker like this?
I mean, I think so. I mean, the whole concept is sketchy anyway, but without these offshore brokers, I wouldn't be where I am today. I didn't have enough money to pass the pattern day trader rule. I didn't have enough money to open up like 3 accounts. I just had to pray that this thing wasn't really a scam. You know, whenever I complained and yelled at them 10 times, I eventually got my money, and the routing was terrible. Everything was terrible. Like, it's just, this pattern day trader rule is such a stupid thing to me. $25,000 to trade as much as you want. Like, it just, I don't understand it. I think it's so stupid.
So now that you're well above that, you're obviously not with an offshore broker any longer.
Exactly.
Okay, sure. Now, I just want to put things into perspective here, because when at the start of this call, you know, I asked you about losing $40,000 just the other day. And here you are, you started out working at Starbucks. Like, just put that into perspective for us. How much were you earning at Starbucks?
Oh my God. I don't even want to say it because it sounds so stupid, but I was making, I think it was like $100 a week after taxes. I put $60 in my gas tank for my car, and then whatever I had left over, I would spend on my ex-girlfriend. So I basically had nothing at the end of the week.
And how many hours were you working a week?
I think because I was still in school at the time. I was still in like high school and college or whatever. So I had to balance both. So I think I was working like 25 hours a week or 30 hours a week at Starbucks and the rest at school.
Sorry, you're working 25 hours a week and making $100?
Yeah, it was nothing. I was getting paid minimum wage, like as little as it was terrible. Just thinking now that money meant so much to me, and losing $40,000 doesn't even faze me anymore. It just blows my mind.
Man, that's so savage.
Yeah.
Okay, so at what point did you feel comfortable? I mean, obviously there wasn't much risk in losing and leaving Starbucks because you weren't making a whole lot of money. At what point did you make the decision to just go full into trading?
So basically, again, it's going to sound funny, but my girlfriend broke up with me, so I was a little bit upset. So I said, screw it. Why am I going to spend money on this stupid girl when I could be, saving up some money and starting to trade? So after that moment, I guess I was a little bit upset. So I dove full into trading to get my mind off everything. I started researching. I started watching some DVDs. I started to do everything that I could just so I could stop thinking about this person. And it's worked out amazingly. Couldn't be happier.
How long have you been trading for all up, and how old are you right now?
Okay, it's been, I think, 2.5 years. It's going to be 3 years in February, and I'm 22 now. I just turned 22.
That's incredible, man.
Yeah, thanks.
Good going. One of the things which is so crazy about your story is how quickly you've been able to pick this up and get a grasp of, how to trade your way in the markets. I mean, how have you been able to pick up these concepts so quickly?
I guess the best way to say it is I'm addicted to trading. Like, this trading is on my mind 24/7. The first thing I do when I wake up is I check the quotes on some tickers that I'm watching. Midday, I'm just thinking, no matter what, it's always on my mind. Before I sleep, it's on my mind. What am I going to do the next day? How am I going to plan my trades? I'm out with my friends. I'm drinking. I'm thinking, okay, what's the next stock that's going to be in play? How do I nail the stock? What do I have to do to become the best of the best in trading? It's become an obsession in my head. It's become like the only thing I think about. It might not be healthy, but I love it so much that I can't stop. It literally is. It means everything to me.
So obviously you've got a clear obsession for trading. Do you have an obsessive personality, like by nature? Like, does this, can you track this back to things in your teenage years that you were that just really obsessed about?
So basically, I guess when I want to do something, I try to be the best at it. Whether it's trading, whether it's in school, whether anything, no matter what, I try to be the best in anything that comes in my way. So with trading, it was a challenge because you could never master the market. The market is always going to be smarter than you. So it just blew my mind that no matter how hard I study, no matter what, the market is ever changing. So even we saw with all these shippers, they're blowing everyone's minds because these moves are crazy. They're absolutely nuts. And it's something that we're not used to. It's something that the market is doing. We have to get used to it eventually. This might be the new norm. What if these new shipping stocks are going to happen more often? What if the next sector is, who knows, like coal stocks or whatever, we just always have to be adapting. We always have to be learning. And the moment we stop adapting is the moment we're done.
So maybe walk us through your typical day. You know, you said that pretty much from the minute you're up till when you go to bed, you're just thinking and obsessing about trading. Walk us through a typical day.
Yeah, so basically, I don't really get much sleep at night. I guess I have like a sleeping problem or whatever it is. So I'm usually up pretty early. So let's say normal day I'm up at like 5 a.m. You know, I wake up, check the quotes, you know, go shower, think about trading. What am I going to do? And then I start checking the pre-market gappers to see what's up on the day. I do a little bit of research before the market's open. I usually just hang out like really early, between like 5 to 7 a.m. And then from 7 a.m. to 8 a.m., I'm always like on the screens watching how the stocks are acting, how they're trading pre-market. Like, is there like a trend that's forming? Is there some sort of news that came out? Like, what is moving these stocks? And by the time the open comes up, I usually have a plan set up. Sometimes I write it down on a piece of paper. Other times I just wing it. But mostly I find more success when I just write down my plan and stick to it. So, for example, let's say tomorrow there's these shipper stocks are flying again. So I'll probably wake up in the morning, see how they're acting. Did they gap up? Did they gap down? Which stock am I most interested in? Why is that? And then form a plan. For example, I'm going to try to find the weakest shipper amongst all these stocks, the weakest, the relative weakness. And then from there, I'm going to plan my trades according to the support and resistance of that stock, and then get my orders ready. And then by the time the market opens, hopefully if they spike up hard enough, they'll hit my orders and we'll get the day going.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
In the years that you've been trading so far, what would you say have been the biggest challenges that you had to overcome?
I think it's in my nature to be very stubborn. I am incredibly stubborn no matter what situation I'm in. And that really shows in my trading. You know, if I'm trading a stock with size and it's going against me, I say, you know, screw it. I have the money to sustain. What if it goes, you know, let it keep going up higher? You know, I could take some blood, you know, let the stock kick me in the balls. You know, I'm stronger than that. And it just shows on situations like this, like DRYS. If you're short at, let's say, $30, you have 1,000 shares at $30 short, and it goes to 40. You say, I'm down 10 grand. No big deal. You know, I could sustain that. What happens when it goes to 100 and you're down 70 grand? It's crazy. So that's something I struggle with now. I have to learn to cut my losers faster. I usually cut them too late. I usually cut them when the pain is too big and I'm just like, I can't deal with this anymore. If I cut my losers earlier, I would probably be a millionaire by now. It's just crazy, but it's in my brain to be so stubborn. And if I could just fix that problem I have, I would be such a better trader on so many different levels.
Have you made any effort, like any real conscious effort to try and change that? Like, is there anything you've tried?
Yeah, so I've tried using stop losses and they've been helping, but I always feel like when I get stopped out, it's always at the top, you know? So what I've been practicing is setting the stop loss on half my position and then seeing what happens next. If the stock goes even higher, then I'll stop out the rest of my position by myself. If the stock goes lower after my stop, I'll just re-add it back, half my position. So that way it's a little bit of a balance. You know, sometimes the stop will take over, sometimes I'll take over, depending on the situation.
Right. So when you get into a trade, do you have in your mind like a predetermined amount that you're willing to risk on that trade?
Not really. No, I never set a predetermined amount that I'm willing to lose. I usually just play it based on the chart, you know. So, for example, EGLE, when I lost, $40,000, I said, you know, worst case scenario, the stock is going to go against me and I'm going to probably lose like 10 or 20 grand. Like, it's not a big deal. Like, I thought to myself, you know, whatever. This is a winner. This is a sure thing. I know it's going to drop. So I said, you know, it's not going to be really much of a big deal. But then when DRYS started to reverse, I said, oh shit, maybe I'm fucked. Maybe I have to cover. Maybe I have to take my loss. So I didn't even look at the P&L. I just had to get out of the chart as quick as possible. And then I saw the damage and I was like, shit, this sucks. But luckily the stock, this EGLE is up like $3-4 more since I covered. So I guess I did the right thing for now.
Right. So I want to stay on this for a little longer. I don't want to skip over this. You know, I think it's very interesting that you approach things this way because it kind of goes against a lot of the, you know, conventional wisdom, if you want to call it that's floating around, is having either a stop loss or a predetermined price point or knowing what's going to cause you to get out of that trade. But you're not really like that.
Yeah, I think that's going to cause too much emotional trading. If you say like my number is, let's say, for example, my maximum loss is $10,000 in a trade. I mean, it is the smart thing to stop out at that certain point, but sometimes I guess it's my nature too that I like to risk a little bit more. So I'm a very risky person. I like taking risks like in any situation. So when I see the stock going against me, sometimes depending on the situation, instead of stopping, I'll just add a little bit more. And I'm not going to add to the point where I'm add till oblivion. I'm going to add where it makes sense. And if I'm wrong with that add, I'll take it off 10 cents higher, 20 cents higher. But at least I tried, you know?
So when does it make sense for you to add to a losing position?
It depends. Like, so for example, let's say this EGLE, it went from, I think the day I was short, I think it hit $8 and then started to sell back off. And then ramped a little bit again, it's like $7.50. So what I do, let's say I had like a 720 average, 730 average, whatever it was, and it was at $8. So when I saw DRYS reversing at that point, EGLE started reversing. So I said, this might be it. It's time to add. So I added there. The stock went down a little bit more. But then when the whole thesis of DRYS changed, when it reversed itself, that's when I knew, okay, this thesis isn't going to sustain. I have to get out no matter what.
I don't know. I don't really know how to word this correctly, but a lot of what you're doing in managing your trades once they're on is just trying to really gauge the emotion of the market and really trying to work out, like, I guess where price is going, like everyone is. But like you're managing the trade extends a lot further than from the point where you get into the market and have a predetermined stop. Really tracking and trying to have a really good read on where the market's going.
Yeah. So, I mean, if you say like, I'm gonna play EGLE, I'm gonna lose $5,000. As soon as I lose $5,000, I'm gonna be out. The moment you lose $5,000, you're gonna be fucked up in the head a little bit. You're gonna say, I lost, I suck, whatever. And that's gonna cloud your judgment for when the reversal really does happen. So I'm okay with taking the loss if I have to at a certain point, but I'm not gonna say I lost 40,000, I'm done for the day. I'm gonna say, okay, I lost 40,000. You know, I suck. I was an idiot. This was avoidable. But when the stock reverses, I'm going to be right back in there hitting it with size. It's not going to be just to make the money back. It's going to be because I was wrong in the short term, but I have to re-attack. I have to hit the stock. I'm not gonna sit in a corner and cry if I lose. That's what people are gonna do, and they're never gonna succeed. You have to overcome that loser, even if it's 5,000, 10,000, 20,000, whatever it is. You have to think past that and focus on being the best trader, being in the best trade that you could be.
Okay, so this has probably become a little bit easier for you to do now that your account's a lot larger, but in those earlier days when you were trading accounts that were really just a few grand, were you much the same? Like how has your trading changed from when you were trading, let's just say a $5,000 account to what you're trading now, like a few $100,000?
Yeah, so when I was trading with a smaller account, my idea was do not short any bit of size until the reversal is confirmed. I said I have too little money to risk that if I'm shorting before the reversal, I'm asking to get wiped out. But now with a bigger account, I guess I have the leeway to short a little bit early, to throw out some feelers into parabolics or throw out some feelers into bigger size charts and slowly add on the way down rather than let the stock collapse and then add. It's a little different, but I mean, it's been working for me.
In that same sort of period, was there any like defining moments or turning points, things that changed for when your average P&L for the day went from perhaps maybe a few $100s to, a few $1,000s? Was there any like big changes that you made to your trading that started to ramp up the pace that you were growing your account?
I mean, I increased size, but it was just consistent gains. Like what grew my $5,000 account and what grows my accounts now is very, very different. So what grew that $5,000 account was consistent gains every single day. No matter what, I would show up to the market. I could make $500. I could make $1,000. And then I'd cut my day off. I'd take a nap. I'd do whatever I had to do. And I was just growing my account every day, slowly but surely. Now, what I try to do is I try to find those perfect opportunities, those 90% opportunities, and trade those. So that doesn't mean trading every single day. That means maybe trading once a week or twice a week or maybe like once every other week. I try not to trade every day. I try to trade only when my specific setup shows up. So for example, this week I've been trading every single day. I haven't left the computer because my setups are there. I keep telling everyone these shippers are crazy. They're going to be a once in a lifetime opportunity, both on the long side and the short side. So I can't afford to leave my computer for a second. These opportunities are so big that when the time comes, I have to hammer them lower. It's just, it's crazy to me, honestly.
Do you really think it is a once in a lifetime opportunity though? Or is that a little bit of FOMO?
Sure. I guess it's not a once in a lifetime opportunity, but it's been kind of slow in the small cap world, and seeing a stock go from 5 to 115 in less than a week is going to light up everything. Everything is going to be lit up for a few weeks. So after these shippers run, let's say some chat rooms are going to try to pump the next big thing. And when that happens, they're not going to have as much fuel as this one did. So the fade is going to be even bigger. So I'm trying to stick to the market, stay on my computers to try to anticipate those trades and short them on the way down.
Now, I just want to pick up on something you said there. You said another chat room might try to pump a certain stock. Is that really the way that it works? You know what I mean? Like, does a chat room actually have the power to be able to really drive a stock price higher like that, or lower even?
It depends on the subscriber base. So let's say one chat room, whatever, let's say they have 1,000 members, right? And the main guy is buying 10,000 shares of an incredibly illiquid stock. Like this stock trades, let's say 500,000 shares a day, like on a regular day. This guy's buying 10,000, 20,000 shares. If a quarter of his chat room buy 1,000 shares, that's already like 250,000 shares, right? So it's just going to push the stock much higher. And then what happens when everyone starts to sell, or when there's no real demand for the stock, it's going to go back down. So I live for these chat rooms. I pray that they buy everything, because usually it goes right back down instantly.
I mean, we might have already covered this a little bit, but let's just go through it again and maybe a bit more in general terms, I think. So what are the qualities of your ideal trade or your ideal setup, scenario, whatever you want to call it?
Okay, so my ideal setup are these sympathy plays that are going on right now. So basically what I'm sure most people thought is when DRYS was halted, everyone said that these stocks are toast. They're collapsing. They're nothing. That's it. The head of the snake is gone. Short these to oblivion. And when DRYS halted, these stocks went down almost instantly. But to everyone's surprise, they held a bid. They started trapping shorts again. They went even higher and higher and higher. And they're still continuing to squeeze people. So now, since DRYS is halted, there are other shipper stocks that are still going up that are, quote unquote, the new index for shipper stocks. For example, SINO is the most powerful. It's at nearly $8 or $9, whatever it is right now. So tomorrow morning, depending on how SINO moves, it's going to fuel these other stocks higher. So tomorrow, what my plan is going to be is when SINO starts to reverse, I hit a different sympathy hard. I short it as hard as I can and hope that it's time for these to reverse. And if I'm wrong, if SINO starts to reverse, I'm just going to take my loss. I can't fight these shippers. They're too strong. But basically, my strategy is find the main stock that's running and short their sympathies when the main one starts to reverse. That's what I try to do. That's usually my best, most profitable setup.
Okay, and when you say you're going to try and hit these hard, what does that mean?
I'm going to short as much as I can. So let's say it's going to be 10,000, 20,000, 40, 50,000 shares. I'm going to try to short it and hold it for a few days because we all know that after the hype is done, they're going to go back to normal. They're going to go back to where they came from. Stocks that went from 2 to 10 are going to go back to 5 by the end of the week, and then they're going to go back down to 2 by the end of the month. So what I'm going to try to do is when the main stock starts to reverse, when the new head of the snake is cut off, I'm going to short sympathy plays and hold for as long as possible for as much downside as possible. Because we all know these stocks really, they have to raise money. They're toxic companies. There's no real reason to be up rather than a sympathy play. So as soon as all these longs get stuck, it's going to reverse.
So I might have misheard you there, but did you say you might hold these for a few days or you'll hold them for definitely overnight?
Yes. So right now, the shippers have not reversed. So I'm not holding anything overnight yet. But when they do reverse, I plan on holding maybe 2 or 3 days because usually the bleeding doesn't stop in one day. They continue to bleed for a couple more days. So that's also something that I'm trying to work on. I'm usually quick to cover. I'm usually quick to take my money and run. But I've realized that for more successful traders that if you wait a few days, if you stick around for that quote unquote hard money that you just have to wait and be patient for, the payoff really is worth it. The money is really there for your taking. Because after a day or two, traders are just looking to the next stock that's moving. They forget about this stock and it just starts to sell off when no one's looking.
Now, from the way you've been talking, it sounds as though you hold pretty large positions. How do you adjust your position size when you're holding a trade overnight? Is that something you do?
It really does depend on the situation. So when a stock is below the VWAP level, that is my tell that usually it's very weak on the day, selling off under VWAP, closing near lows. I think to myself, what reason do I have to cover? Like it's probably going to go lower the next day, but maybe I'll take off like a third of my position or half of my position just so that in that case where it goes a little bit higher, I've locked in some money and worst case scenario, I'll just reshort it tomorrow a little bit lower.
Now, throughout this episode, we've been talking a lot about the shipping container stocks, but just more broadly speaking, how do you identify these sectors and industries that are starting to gain momentum?
Well, usually there's a lot of people on Twitter talking about it, or chat rooms are talking about it. But when they start to stick, when something like this sticks, like before it was, let's say Ebola or forklifts or whatever it was, when they start to have these sympathy plays in the similar sectors that every single person is talking about, every single person on Twitter, every single person in a chat room, they're only trading these stocks, that's when you know that there's something going on here. This is when DRYS goes from 5 to 105 or 100, whatever it was, it's going to get people talking. It's going to get people, everyone's going to be curious. Everyone's going to have it on their screen. Everyone's going to be watching every tick of it. It's just, the more eyes that are on it, the crazier everything could get.
And what would you say is your ratio of trades on the long side compared to the short side?
It's pretty pathetic, but it's usually 99% short and 1% long. And the only time I long is usually when I lose in a short. Let's say, for example, I think it was CANF, like a while back, a few months back, whatever it was. I ended up losing $20,000 on the short. And I said, okay, the short isn't working. The stock looks like it's going to go higher. So let me buy it. Let me reverse my bias. Let me reverse my position and just buy the stock. I ended up buying the stock with a bunch of size. I ended up selling for, I think it was a $50,000 win. So it ended up being a $30,000 win on the day after the $20,000 loss. So usually when I long, it's because my short position didn't work out. I see the chart is going to reverse, so I reverse my bias.
Okay. Now, these are not small numbers that we're talking about. Like, you're 22 years old. You make me feel old. No. What do your friends and family think of your trading efforts and the amount of success that you've seen so far?
Basically, my friends really have no idea how much money I'm making. They just know that I trade stocks and that I'm doing well for myself. They have no clue about the numbers. If I tell them, they just won't understand. It'll blow their minds. Like, they'll say I'm crazy, I'm an idiot. Like, what am I doing? You're risking too much. And I say, I'm 22. This is the time to risk. I really have nothing to lose. I have no bills. I have no mortgage. I live with my dad. Like, I think that's one of my benefits too. I don't really have to think about bills. I don't have to think about where I'm going to put my money. Like, what am I going to do? If I have a good month or a good week, I'll wire out some money and keep it in my bank account, save it for like a rainy day. And that's about it. I don't really spend that much money out. I really don't have much of a reason to spend except going out on the weekends with my friends.
So why do you not share this sort of thing with your friends?
I don't think they'll understand it. I don't know. I feel like maybe it might be a little bit of showing off, and I just don't think they'll really get it. They know that I trade stocks. They know that I short stocks, but I don't really get into numbers too much unless I'm talking to someone from the trading community. Then I'm like an open book. I tell them everything. No matter what, send me a question about my numbers and I'll tell you, because they'll understand. They'll know what I'm going through. My friends really, they don't know the stock market, so they won't understand much of anything.
Sure. And what do most of your friends do?
One of my friends does real estate and jewelry. The other friend owns a hardware store. Another one is doing pre-med. He's going to be like a surgeon. The other one's going to be a physical therapist. So I guess they're eventually all going to be doing well for themselves. So.
No, that's really cool, man. Outside of trading, I want to talk to you about this. I think it was earlier this year in 2016, or maybe it was 2015. Anyway, doesn't really matter too much. You renovated a house and flipped it. So tell us a little bit about that. Like, why did you decide to do this?
Yeah, so I think it was 2015, the Las Vegas Conference Traders for a Cause. I met a guy, Louis, Monaco trader on Twitter, and he made most of his fortune from not trading, but from real estate. So he trades just because he loves it, but most of his money is from real estate or venture capital or whatever else he does. So we met up at Vegas. We talked a little bit by the pool, and he said, what are you doing? Like, what is your long-term plan? And I said, I have some money in the bank. It's just really chilling there. It's not really doing much. And he's like, have you ever thought of real estate? And I'm like, like in the back of my head, I thought about it, but it sounds like a lot of work. Maybe it's not for me. And he just gave me some pointers, some tips. He mentioned his story about how he started in real estate. And I guess there was like he planted a seed in my head. He said, you could do it. You're not a dumb kid. You're pretty smart. A lot of people could do it. It's not a problem. So I think the conference was in, let's say, October or November. The market started slowing down November to December in 2015. So I said, screw it. Why not get into real estate? What do I have to lose? I'm going to learn a lot. It's going to be a cool experience. The market's slow. So I guess I started doing research about what is like a potential good property to buy and flip and whatever. So I ended up coming up upon like foreclosure properties, and I started looking at a bunch of them, and I eventually found one that I enjoyed like that. I said, this one has potential. I see the vision in this house. So long story short, I ended up buying the house, and I guess that was the easiest part of it, buying the house. And then I had to think, like, how the hell am I going to do this? I have to hire a guy to do it. I have to hire a contractor, a plumber, an electrician, some guy to do the masonry at the front of the house, a roofing guy. And it was really overwhelming because it's like trading for the first time. You really have no clue what you're doing. You could press a couple buttons, maybe you'll be lucky, but really, like, you have no clue. So I said, what the hell am I going to do? Like, so I started interviewing. It's funny because I started parking my car outside a Home Depot at like 7 a.m. and calling contractors from their vans, like from the numbers I saw in their vans, and just saying, hey, I have a house in this area. Do you mind if you could come in and maybe give me an estimate on what the work would cost? So I called, I think it was like 30 people, and they all came in. They gave me like varying quotes from like $20,000 to like $70,000 to like fix the house. And you can't ever choose like the cheapest guy because you don't know what kind of work he'll do. You can't choose the most expensive guy because it's not going to fit your budget. So I was a little bit frustrated. So I went out to drink with my friends, and I guess I got a little drunk and started telling him my problems. And one of my friends, he actually owns a hardware store. So he deals with contractors every single day. They come in to buy paint. They come in to buy like anything. So I said, if you find me a good contractor, I'll buy all my materials from your hardware store. And he's like, done, deal. So literally he found me a guy. He was one of the cheaper guys. My friend vouched for him, and I said, all right, let's do this guy. Let's use this guy. And long story short, he had a couple friends that were electricians and plumbers and whatnot. So I guess it all worked out. But yeah, so the work started, and he would just call me and he'd say, I need this, this, and this. And I'm like, all right. And I would go to the Home Depot or whatever it was and just find the materials. Like, I had to choose the hardwood floors, the paint, the kitchen materials, everything. And this was all like my first time doing anything. So I had to I basically winged everything. I didn't know what the hell I was doing. I went to Home Depot. I went to all these like tile specialty stores, like a kitchen store, whatever it was. And I started picking things out that, I would like in a house. So I picked dark wood floors. I picked the paint color. I picked the kitchen with granite countertops. And I guess before I knew it, everything started to come together. I mean, there were a bunch of problems like in between, like contractor nickel and diming for like stupid things or like stupid problems coming up. But as annoying as they weren't that hard to overcome. It just took some common sense and like some negotiation to fix all these problems. And the whole process from buying the house to selling the house was about, I think, 4 months. And then like there was like another 2 or 3 months of like attorney review, making sure the buyers could get a mortgage and all this stuff. And it was really an interesting experience. I learned a lot. I learned about how crooked these contractors could be. I learned how important like my friendships could be with my friends. We help each other. And overall, like the whole experience was cool. But in the back of my head, I was still always thinking like, I miss trading. Like when I was doing this house project, I wasn't trading that much. I was trading once a month, and like just so I could get like my addiction settled. Like there really wasn't much plays or whatever it was. And I was just thinking like, this real estate thing is cool, but trading really is where my heart is. Like it's still what I'm thinking about. Like, so when the house got sold, I started trading again. I had more time to trade again. And I guess the timing was right. Everything was right. And all these stupid stocks, like these sympathy stocks or these low flow plays were back again. And no hesitation, I was back in my element. There was no, it was like riding a bike. I knew exactly what I was doing, and it turned out to be one of my most profitable months of the entire year. I did really well the first month I came back. And since then, it's just trading's been on my mind 24/7.
Right. So do you have any plans of doing, another venture into real estate?
So like I said, my contractor was nickel and diming me for everything. And it was just so frustrating and annoying. Like by the end of it, I was just so sick of him. So, I mean, I think a lot of this whole real estate thing depends on your team. It depends on who you're working with. Are they people you could trust? Are they honest people? Are they people that aren't there to screw you? And my guy, as much as my friend vouched for him, he was there to screw me a little bit, He's there to make his money, whatever it was. And from that guy, just that one guy, discouraged me from doing this whole thing again. But if I found the right team, honestly, I'd be happy to do it over again. It was a really cool experience. I loved the feeling of turning a garbage house. There were holes in there and smelled like shit. It was terrible in there. And I'm glad I turned it into something that someone could live in, They're going to start a family in there. And it's just all from a stupid garbage property that if they saw before, they would never think about buying it.
Yeah, so if you did do it again or when you do it again, obviously the team is a big one. You'd make sure you had a better team or a team that you click with. Is there anything else you would have done differently? How did you go budget-wise? I know it's very easy to go over budget when you're renovating a house or, and picking the wrong house. It's very easy to lose money in real estate, just as easy as it is in trading, I think, to a certain level. Is there anything else you would have done differently?
So the area that I bought the house in obviously wasn't the best area possible because it was very, very cheap. So the way I did the house is basically everything I loved, everything I thought would look cool. But all those things take a lot of money. They cost a lot of money. So what I should have done differently is not think about what I want. I had to think about what buyers in the area want. And that would have saved me a lot more money. Instead of using granite countertops or decent appliances, I could go with the cheapest appliances and the cheapest countertops and the house would still sell, So I guess I was doing it for the first time. I didn't really know what I was doing, but now that I know a little bit better, I know what it takes to flip a house profitably. It depends on the area. It depends on the kitchens, the bathrooms, or whatever. And I just learned that I was cheaping out on the bathrooms a little bit. And I know now that if I wasn't cheaping out on the bathrooms, the house would sell a little bit better. I was garbage. The bathrooms I thought were garbage, but I don't know. I mean, I made some money on the house. For my first project, I made some money. I'm happy about that. I was ready to break even or even lose a little bit of money just so I could get that knowledge, but I'm glad everything really worked out.
Yeah. Oh, that's good, man. That's good. And I think you went into it with the right attitude as well. I mean, learn before you earn in some ways. So, no, good on you, man. That's awesome. Anyway, Alex, let's leave it at that. Is there anything else you want to add? Anything you want to share with listeners before we call this a wrap?
I guess the most important thing is that when you're trying to grow a small account, always focus on consistency. Find a setup that you're really, really good at, a setup that you'll win at, and trade that. You have no reason to trade something like Facebook if it's moving on earnings just so you get a rush or whatever. Find something that you're good at. Find consistent profits, and your account will grow really fast. I couldn't believe how fast my account grew when I was being consistent, trading every day, trading setups that were there for me. It's just the little things add up. It might take time, but trust me, it adds up faster than you'll imagine.
So where's the best place that listeners can go to find out more about you?
I guess my Twitter or my blog, they're both on my Twitter. I guess my Twitter is ATO9_trader, and my blog is ATO9trader.blogspot.com. So, I mean, I have some story about my real estate thing there. And I post on Twitter pretty regularly about some trades I made or some thoughts. So that's about it.
Excellent, man. And can you just repeat your Twitter handle one more time in case someone missed that?
It's AT09_trader.
Okay, good stuff. Alex, thank you very much for coming on the podcast, man. It's been a blast to speak with you. Thanks very much, man.
Definitely, man. Thanks for the opportunity.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders. Zero Hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
So here we are, team, for the first episode of 2017. I do hope there are big things in store for you this year, so let's go. My guest, who you're about to hear from, is Tony Duff. Long story short, Tony was a hedge fund trader on Wall Street who led a truly excessive lifestyle. In 2013, he released a book about his experiences titled The Buy Side, and currently, Tony is a consultant on the Showtime TV series Billions. On this episode, we cover everything from what it was like to trade more than $1 billion at Galleon Group, which was the hedge fund run by Raj Rajaratnam, currently serving an 11-year prison sentence for partaking in one of the largest insider trading cases in US history. Following on from this, we discuss Tony's relationships with the sell side and the extreme measures they'd take to win his business, which then led us into their shenanigans which took place after hours, the cocktail of drugs, alcohol, sex, money, and power. We finish up with Tony's fall from the top, some of the greatest realizations he's come to, and the life he leads today. Please enjoy this episode, guys. Here it is. My guest, Tony Duff. I noticed that you've had some involvement with the TV show Billions. Do you want to tell us a little bit about that? I think you've just wrapped up season 2. Is that right?
It is correct. And thank you for having me. So I wrote a book called The Buy Side, which published in 2013. And what happened was it was optioned by Sony, and they put a team together. And so going into 2014, there were a number of competing projects, and apparently there was this show over at Showtime that was, about to be bought, and so then they announced it, and Sony kind of, dragged their feet a little bit and got lukewarm because they were nervous that there was already a Wall Street project out there, and so my book went away from the Hollywood side. And I don't know, maybe 6 months later, I got a phone call from the 2 executive producers, and they said, "Hey, we'd love for you to read the pilot. Give us your thoughts or whatever. We're going to be shooting in a couple of weeks. Are you up for it?" And I said, "Yeah, definitely." And so I read it twice in one weekend, went in there, and basically just gave them my opinions. And it might have been, well, a hedge fund guy would have never said this, or this is how this might go down, and that's all I did. And after we had a meeting, they said, we would love to hire you as a consultant on the show.